I'm also opening the chat just in case, but of course I can get distracted. Huh? I mean, we can always adapt. No, if we see that there's, I mean, I can even handle them. Like if I see that there's too much interruption, then. But I don't think there's never enough. No, I don't think there's ever enough interruption for.
I think you're right. Okay, well, this is great. I think we're ready to go. The live stream is on and everything. So welcome back, everybody. We're very happy to have David Thesmar here today from MIT, and he's going to be talking about micro methods for macro finance. Just a reminder, if you have a question, let's try to use the raise hand feature today, and David will call on you. You can also type in the chat, but let's try to use the raise hand feature as well. We'll have a break at 10:30 Eastern. David, floor is yours. Take it away.
Thank you so much. Thank you so much, everybody, for being here, and thank you, Mike, Andrew, and Alexis for giving me the opportunity to do this small lecture. So there's always the question as to how we organize this. So let's do as Alexis says. You can raise your hands. I'm going to try to keep track. The team will help me keeping track of your hand raising progress, and also I can take a look at the chat. Okay, so today's class is on micro methods for macro finance. Again, thank you so much, Alexis, for finding the title. It's a great title, and I wouldn't have had it otherwise. Okay, let me just change the format here. Paper. No, that's not it. Up. View. Single page. Exactly. Okay. So let's imagine you're asking yourself, the following economic questions, such as, what are the aggregate effects of, say, financing constraints? So firms are financially constrained, or individuals are financially constrained. What is the aggregate effect of this on, I don't know, the allocation of factors in the economy, or the growth of the economy, or the output of the economy? Or for instance, let's imagine that you want to estimate the aggregate effect of a financial reform, such as, I don't know, banking deregulation, for instance, which is the one we're gonna look at later. Let's imagine also that you are interested in, trying to evaluate the aggregate effect of mistakes that people are making. So you can observe mistakes that people are making, but at the individual level, you would want to know whether that's a big deal or not at the level of the economy, or even other questions that we won't have time to discuss today, such as, for instance, what would be the effect on the aggregate labor share of imposing profit sharing, mandatory profit sharing on all firms in the economy, starting from a small experiment that affects a few firms, or whether you think about what is the optimal trade-off in the economy between the dividend tax and the corporate tax. So you've got all these questions. So to answer these kind of questions, and I'm going to focus on the first three today, and that's already enough in 3 hours. Let's hope I can even get there. To answer these kind of questions, our approach will be to bring together two traditions in economics. The first tradition is the one I am from, which is the applied micro / credibility revolution back in the late 1990s, when I started out my dissertation. I was working at the statistical office, and there, they had like tons of data in France, of course, as you can hear from the accent. So I was working there at the statistical office. They had tons and tons of data. And the economic research was starting to apply very simple methods in order to answer simple questions in a credible way. So that's the Engris-Kruger kind of Pischke, Engris-Pischke kind of revolution, where you take these huge data sets which are of individual behavior, and you try to distill them into a very credible and simple mechanism. So you try to isolate the mechanism in a clean way. That's the literature I come from. And what we want to do here is to bring this tradition, which is, diff in diff kind of people, let's put it this way, the identification police, or even the identification army, with structural estimation / macro modeling. So either structural estimation of micro models or structural estimation of macro models. And the advantage of this second stream of literature and of papers is to be able, and it's not papers, it's tons of papers, there's millions of papers, is to give you the chance to estimate counterfactuals, quantify macro effect. Okay, so for instance, if you have a macro model where firms are financially constrained, suddenly you can simulate exactly the same model where firms are not financially constrained and compare the two macro outcomes, let's say to GDPs, to total factor productivities, etc. And so that's what the structural estimation buys you the ability to estimate counterfactual and quantify macro effects. So what we'll do today is to bring these two approaches together. So all of this work, so all of the papers I'm gonna mention today are papers with David Schreier from Berkeley. So that's a line of research that we started out with in the early 2010s. So that's kind of, there's a series of papers, not that many of them. It takes a while to write them. So that's why, but that's so that's really with him and many other co-authors that I'm going to mention on the way, which were critical in making this progress. Okay, so before I go to the heart of the matter, let me just ramble a little bit more on how these two traditions complement one another. So there is, so the identification revolution happened first in labor economics, and then it pervaded the empirical corporate world starting in the early 2000s. So in the early 2000s, people started to ask corporate finance questions with the same kind of tools as the ones that people had developed in labor. So that's our original habitat. So Schreier and I, back in the 2000s. So what it allows you to do is two things that are where it was immensely successful at, which is first, that it disciplines causal statements. You define very clearly a null hypothesis, such as, Modigliani-Miller holds, or financing doesn't affect investment. Okay, so that's your null hypothesis. And then you build a whole machinery based on, data and detailed data and plausible exogenous mechanisms to reject well. And, so for instance, we've rejected, in many papers, the fact that Modigliani-Miller holds, but many other, in asset pricing, people have rejected the fact that, markets are efficient, for instance, things like this are perfectly efficient. The other immense success of this approach, okay, is that it's very easy to convey and very easy to understand. So it makes papers easy to discuss in seminars. So seminars are lively because people get it. It's simple, they have the ability to see through the data because the methods are so simple and conceptually simple too. And it gives rise to lively seminars because then people can challenge the identification assumption. So the identification is clear, whenever, Modigliani-Miller holds, investments should not be sensitive to cash flows, for instance. And then people might, challenge that assumption, which is the assumption under which you're testing the null. And they might propose alternative mechanisms. And those alternative mechanisms will, then translate into robustness checks. People will try to find ways to challenge the, to test, to push back on the challenge, etc., etc. So that's, that's the success of this literature. However, in spite of all this success, and this is not over, of course, that literature leaves open many, many questions. For instance, one very simple question. If you have rejected a null hypothesis, that's all good, okay? So for instance, markets are perfectly, flawlessly efficient. That's rejected, okay? But then, is the measured effect large enough that we should care? Is the deviation from market efficiency something that we should care about? That, that it's very big, so prices are way off, okay? Or firms are very financially constrained, or is it just that, we can reject that they are not, but we have such good data that we're able to actually, discern, a very small effect that, should not require any work on it. The other question that's typically left open by a paper like this is whether, or by this research, is whether the finding is externally valid. Okay, for instance, let's think about the famous Engris-Kruger paper on the GIB, for instance. You're giving money to people who went to the army, and so that they can go to college. Okay, so that's valid in the 1970s in the US, in a specific economy, etc. Is it also valid in Uganda, or is it also valid in Italy? We don't really know. So there's always the question of whether we can bring those, how we can generalize those findings. And in general, there's a trade-off, there's an efficiency frontier there where, the better identified your mechanism is, the least externally valid. In general, you have to buy, clear identification at the expense of external validity. And the third problem also, of course, is that, once you've rejected the null that firms are not financially constrained, and you've learned that companies are at least to some extent financially constrained, then what are the policy consequences? And that you have no answer to this. Okay, so for instance, you could say, okay, I'm gonna force everybody to go to school, but that's definitely not a policy that you can implement. Or you can give money to all companies because they're financially constrained. That's definitely, you can already see that this is not a valid policy consequence. So in order to answer those, what helps in addressing those, these questions is to have a structural model. Then you can quantify the effect. You can buy some external validity because you're going to estimate, structural parameters that you believe, apply in all environments. And also you can investigate policy consequences once you model them. Okay, so that's the advantages and the limitations of the first tradition. The advantages and limitations estimation tradition are exactly the opposite. So that's why they complement one another so well. So in structural estimation, assumptions are clear. In principle, and I would tend to think that not all structural papers are rise to that challenge, but that's in principle possible, that all assumptions are crystal clear. Okay, so it depends on how well people can write, etc. But you write down your assumptions, you write down your model, you write down everything, you see everything that's being assumed in terms of economics, while you don't see any of that in a diff in diff, which has just the appearance of simplicity, but in fact, that life might be more complicated, or there might be hidden assumptions that are not clearly stated. Structural estimation does this because you write down the model. That's the first advantage. The second advantage is something that the previous tradition cannot really achieve, which is the ability to run counterfactuals and also to quantify. Why? For instance, if I have a model where firms are financially constrained, I can just shut off the financial constraint, see how the company behaves, the economy behaves, and compare the counterfactual economy where there is no financial constraint and the true economy where there is some. And by running that comparison, I can estimate the cost of financing constraints. But I have to compare what I see in the data, which has financial constraint, with what I would potentially see, which does not exist, which only the model can give me access to. But of course, that tradition runs into other difficulties. There's, I would say, two. So the first one is, and that's always that lingering feeling that we all have when we see a structural paper, at least I would say in corporate or in macro. I don't have a very good insider sense of asset pricing, or not as good as, let's say. That there might be issues with the numerical job, with the actual implementation. Okay, that's not something that we think of when we see a diff in diff paper. When we see a diff in diff paper, it's really a cross tabulation. We think that people have done it right. They might have issues with, I don't know, winsorizing or things like this. But in a sense, it looks hard to not do well because it's simple and it can be replicated, etc., etc. With structural estimation, there are so many steps along the way that needs to be taken, and so many decisions that are critical to the quality of the work, that there's always this sense that maybe it's not done right. Don't get me wrong, I think that most people think do it right, but there's always this adverse selection kind of thing, this lemon problem where some people don't do it right, and therefore you don't quite know whether you should believe in the result or not. For instance, I'm just giving a few examples here, but the granularity of the grid is something that is critical in getting the simulations right and the estimation right, for instance. So when you estimate a model that you have to solve, numerically, the coarseness of the grid matters, or for instance also, and that might also have there might be also an interaction with sometimes, the fact that you might have local maxima, local optima, global minima. So, when you try to estimate the model, there's always the worry that you might be stuck in a global likelihood maximization. So in a local likelihood optimum. So there's this thing. But even if the numerical job was done right, then there's a second series of problem that is not very much present in the literature, which is the sensitivity of structural work to non-model mechanisms. When people see a diff in diff paper, they try to think about alternative stories that can explain the data that they're. In structural work, it's exactly the same. You have a bunch of moments that you try to match. You invent a few mechanisms that you think are critical, that you're interested in, but maybe it might be the case that your moments are actually generated by other mechanisms that are not in your model. And as a result, the moments will be polluted by these non-model mechanisms, and then they will be soaked up by the parameter estimate. So your deep parameters will actually be polluted by these mechanisms you haven't thought about. And that might, entirely bias the analysis. And that's, a concern, a worry that lots of people have when they see a structural work. Also because it's hard to do sensitivity checks in structural estimation. It's very cumbersome, it takes a lot of time, etc. So it's very complicated. And our answer to that would be to say, okay, let's use clean moments. So moments that are exactly pointed at the mechanism you're interested in. So for instance, moments that stem from the identification revolution, let's say a different diff estimate. That is exactly, that is a consensus of the mechanism that you're interested in. And also let's do robustness checks. That means that, you would have to run counterfactual economies where alternative mechanisms happen, and then you would estimate your model on those economies and see how that affects your conclusions. That's something that I will allude to. I will spend some time on, but we have some more work on this. That's actually their challenges that can be solved. But essentially, yeah, so there are the intuitions from one tradition apply to the other, and intuition from the other tradition apply to the first one. So they're like, they are really a complement. Okay, so that's it. So that's kind of the preliminary discussion, and now I'm going to discuss really some economics more than general rambling. So first is a paper that's forthcoming in Journal of Finance that quantify financing constraints. That will be a discussion of how you integrate diff approach with structural approach, but also a discussion on misspecification. So those robustness checks I was discussing earlier, this idea that you would want to test the robustness of a structural model exactly like you test the robustness of a reduced form model. So there's going to be a discussion on this. Then when I discuss another recent paper of ours, where we try to bypass a little bit of the structural estimation. We're going to try to propose a method that allows you to estimate misallocation without actually estimating a structural model at the firm level. So there's going to be a very simple method, basically, that can be used in a definitive context. But that's consistent with lots of potential structural models. So that's where there is a structural dimension to it too. And then the last one is really about whether we should care or not about biases in managerial forecasting. So managers make mistakes. They can be optimistic. For instance, we all think about the famous Malmendier Tate papers of the 2000s, where people I don't know, there's hubris. Managers want to do too many M&As. They're over optimistic, etc. So there's been discussion on this, and various papers document managerial biases. And the question is it something that we should care about or not? So again, here we're going to start from a micro evidence and put it in a macro setting to try to address that question. And then a couple of concluding remarks, leads for future research, stuff I'm thinking about, etc. Okay, so that's the roadmap. Okay, so let's start with financing constraints. Okay, so let's so quantifying financing constraints. So the question I'm interested in here is a very simple question, which is, how much should we care about financing constraints? Okay, huge literature in Empirical corporate, where we essentially show that investment is sensitive to exogenous cash flows. So companies receive, exogenous money, they use that money to invest more. If Modigliani Miller was to apply, then that shouldn't happen. As a result, we've rejected the null that there are no financing constraints. There are financing constraints. Companies that have good ideas cannot invest as much as they want to. Huge literature in macro/development, in empirical, corporate, etc. The question we want to ask is slightly different. We don't want to ask whether there are financing constraints that we are convinced about. The question is, how big are they? Is it something that we should start thinking about seriously, or is it how big is there? How much should we care about it? So there are a few papers out there, and when I'm mostly gonna be focusing on this one, even though there are a few others that we cite profusively in the paper. There's a paper. Sorry, this is for the secretary of the town of the city hall. So there's a paper. So the paper I'm going to discuss. I'm going to start with is Midrigan and Xu, 2014. So that's a very famous paper. The lesson that you can draw from this paper is that financing constraints are not a huge deal unless you add non-convexities in production. For instance, if you have entry cost, okay, so you have a fixed cost that you need to pay for in order to entry, so something that is with some kind of non-convex cost. If you don't have this, if you have like the smoother kind of production functions that we can think about, then there is not much effect of financing constraints. That's obtained. The way they do this is that they take a firm dynamics model that looks a bit like ours. So that's we're going to discuss it more in detail in a few seconds. And they match that model with a piece of data, which is it's not even the mean leverage, it's the aggregate leverage. Okay, so you're taking the aggregate debt in the economy, you divide by aggregate capital stock. So that's D over K at the level of the economy. You use that number to try to to put a number stringency on the collateral constraint, and then you assume that firms operate in equilibrium, product and labor markets clear, and as a result, whenever that lessens a little bit the cost of financing constraints, because whenever a firm is financially constrained, the neighboring firm might not be, and as a result, it can pick up the slack of the first firm. And so therefore, the fact that some firms are financially constrained might not be such a big deal after all in general equilibrium. So that's something they can take into account. The intuition why they don't find such a big effect, okay, not much here. The intuition why they don't find such a big effect is, there are various intuitions, and we're going to discuss some of them. One of them is really, let's just erase a little bit those things. One of them is really coming from the fact that they're calibrating on mean leverage, and I'm going to get back to this later, but also the fact that there is an intuition that was present in another paper that I think was published the same year, which is simply that whenever firms have INADA conditions, meaning that their marginal productivity when they're very little is high, then even if they're way too small because they're financially constrained, they can accumulate enough money to basically grow themselves out of financing constraints. And in fact, they don't need debt that much, so they don't need financial markets. And that mechanism is operating in this model too. Anyways, Midrigan and Xu find not much effect. That's more or less where we are. The problem is here for us, or at least the limitation that we try to address in our own paper, is simply that that mean leverage is a moment that is sensitive to non-model forces. Okay, so think of many, what does leverage depend on? It depends, of course, on how much debt you can take on, for sure. But it also depends on other forces, such as, for instance, taxes. If there are lots of corporate taxes and debt, interest payment is tax deductible, then companies will want to take on more debt. So the tax shield is going to affect, for instance, the amount of leverage. So if there is more tax shield, there's going to be more leverage. And also, of course, the dividend policy affects leverage. For instance, let's imagine that I am a very aggressive firm owner and I'm very risk neutral. I'm not risk averse, so I'm very risk loving even. Then I would want to extract as much, as much equity as possible from the company in the form of higher dividends, and that's going to affect also, my leverage ratio. So leverage ratio is not a direct way of measuring, of estimating financing constraints. Okay, so what we discuss here in this paper is the fact that leverage might not be a good way to measure financing collateral constraints. So the solution we try to take here, the approach that we take here, and that's coming from earlier work of ours, is the fact that you can measure financing constraint using well-identified moment, a moment that's really pinning down financing constraints. So that's a paper with Sylvain, Catherine, Thomas Cheney, Zhongbo Wang, and the ineffable Schreier. Okay. So let me discuss first this very reduced form moment. Okay, so I told you, we're going to use a well-identified moment to measure financing constraints instead of using leverage. So what are those well-identified moments? I'm sure you know all of them. So that's a slide that kind of summarizes very quickly the literature. And actually, I'm not counting more recent papers by Chen Lian and Yuhan Ma, or by Dan Greenwald. Actually, my colleague at MIT have papers on covenants that are tightening up, for semi-exogenous reason, that affect investment. So there's the more recent literature on covenants, but the older literature, you've got a paper by Olivier Blanchard, Lopez de Silanes and Schleifer, with 11 data points, companies receiving cash windfalls from settlements. So suddenly, companies receive money because there's a judicial settlement. They receive a big pot of money. Do they invest or not? That's the question that they're asking. It's just 11 firms. So it's really just, the tables are not regression tables. It's really a list of 11 data points. Then there's a famous paper by Owen Lamont, which is looking at 42 non-oil divisions of US oil conglomerate. So is the toy producing division of an oil conglomerate going to invest more whenever oil prices go up? If oil prices go up, actually go down in this particular cases, is it the case that when oil prices go down in the oil conglomerate, you're a toy division of an oil conglomerate. So when prices go down of oil, then the conglomerate has less money, and as a result, the toy division investing less, even though possibly toy producing facilities might be positive NPV. So he finds that there's a connection there between oil prices and non-oil division investment. But again, 42 data points. There's a famous paper also by Banerjee and Duflo, which is actually way older than 2014. So that's on private Indian firms that are borrowing from a bank. And the loan is subsidized. So some of them are receiving subsidized loans, others are not. And they look at whether that affects investment, 249. Then Josh Rao was also a famous paper with 15 and 22 firms that have underfunded defined benefit pension funds. And as a result, the regulator forces them to, take some cash to replenish the pension fund. That reduces investment. Here you have a few more firms. And then there's a paper that we use here in this structural work, which is an earlier paper of ours, where we have even more firms. So we've increased even more the size of the data set. where you take CompuStat firms, and those firms basically own real estate. Whenever the value of real estate goes up, we observe that they invest more. Okay, so that's kind of, I mean, there are other papers after this one, but that's the one we're going to use here, just to give you a sense of how it works in more detail. Just to be clear, the intuition that we're trying to test is that, whenever your real estate holdings appreciate, that increases your debt capacity. So, so the good news is that CompuStat has real estate holdings for firms. And as a result, what we can simply do is to run that regression where we regress investment of a firm on the value of its real estate. So that means essentially that, if those companies are not in construction, they're not in a real estate intensive industry at all, etc. So whenever the real estate appreciate, they should not be investing more. Yet we find that they are, since beta turns out to be positive. Okay, so beta positive means that we reject the null that the null of Modigliani-Miller of no financial constraint. Okay, so that regression can be run. We have instruments, we have fixed effects everywhere, etc. Has been replicated in many settings. So that's a very robust result. Has been replicated in many settings. But what I want to draw your attention on, so this is a table where we run those regressions in the paper. So here is the number that we're getting in that specification, which is the one that we prefer here. So what this coefficient tells you is simple. It tells you that whenever the value of real estate goes up by $1, we find that capital expenditures increases by $0.06, so that means 6 cents. So the bottom line is this: what we find in the CompuStat data is that whenever companies get wealthier by $1 for exogenous reason, they raise their investment by 6 cents. That's the reduced form finding. The thing is that finding doesn't tell us anything about the size of financing constraints. It's very hard to tell. Is it something that is important or not? It's really hard to tell. So that's why we write down a model of structural model.
David,
so that's
can
yes.
I just
go
ask
ahead.
You real quick? I guess I should have raised my hand, but are the numbers similar across all these reduced form papers? So it's going back to your earlier point about external validity. So aside from the fact how they might aggregate, are they at least comparable? So we have a chance.
So that's a great yes, that's a great question. So the only one I don't know all the numbers by heart. Actually, I should do that. So is it so that has been done in China, in France, that I know of at least, in the UK. So in those countries, I don't know how big it is. I think in the UK it's similar. The paper I remember well, because I teach it every year, is a paper that has been replicated on census data. So that's non-listed data in the US. So same country, but firms that are smaller, not firms that are publicly listed, but firms that are not. And there they find exactly the same number. They find 0.06. It's almost as if we had paid them, even though we didn't. So it's the same number. Yes, we get the same. I would. Okay. For the rest, I don't remember for sure, so I don't want to say anything wrong. But it's a good point actually to see whether the numbers. Yeah, it's a good point. Yeah.
Let's see. Are there any other questions? Seems like maybe it'll be a good time to feel free to jump in. Okay. If not, let's keep going.
Okay, so let's write the model. Maybe there's going to be more questions then. So the model we write is the simplest possible model with real estate and financial frictions. We write a simple model of firm dynamics. Firm invest, they borrow in order to invest, they issue equity, etc. But they own real estate, and when that real estate appreciates, they can pledge more of their collateral in order to invest more. That's what the model is going to do. We're going to require that this model matches the reduced form moment I'm going to focus on. And then the question we're going to ask is whether it means large effects of financing constraints. So is that beta of 0.06, is it something that translates into a big effect or not? And the question, the other question I'm going to spend some time on is whether this reduced form moment is more robust to misspecification than leverage. Okay, so there's this issue of misspecification of structural models that I discussed earlier, which is essentially that, leverage, the leverage moment that everybody uses in the literature is a moment that contains a lot of different effects, and not just, financing frictions. For instance, firms may borrow a lot because they're financially constrained and not because they are not. I mean, you can imagine lots of possible stories. While we believe that our moment is more specifically tied to financing constraints. So, what can we say about that? Is it true that our moment is more robust to misspecification? It's a very hard question to answer generally, but at least we give some leads of experience, some leads. So misspecification. Okay. So the models. Very simple model. So please stop me here if you don't understand it. There isn't that much to follow here. It's very simple. It's NC weighted essentially. That's kind of the reference here. NC weighted. Is it 05 or 07? I never quite remember. So let me write down 07 just but on a whim, but it might be 205. So in that model, what we have here is a company that has two state. So there is no I subscript, but there's lots of companies in our economy. Company has a capital stock, capital K, and an amount of debt, small d. And there are other state variables that are exogenous, so they are not the firm's responsibility. So that's Z and P. So what is Z? Z is the productivity of the company. It follows an R1 process, and the red parameters here are going to be estimated. Okay, so these parameters are going to be estimated to match various moments. Here we have the price here. Also, PT is a price that is an R1 that is not estimated, but that is calibrated on real estate prices. It's almost a random walk. Okay, so we've got the price of real estate, and we've got the productivity process, which is an R1. Okay, so now what is the firm's problem? It's here. So the firm solves the following Bellman equation here, which is, where the value function of the company depends on capital and debt, the two state variable here, two endogenous state variables, and the exogenous state variables, and it's going to be the discounted sum of future cash flows. Okay, so this here is the cash flows. Okay, and this is the discount rate of this firm. So I'm doing something that people do all the time in this literature, which is to assume that there is no aggregate uncertainty. So that the aggregate shareholder, which is a representative shareholder, has a very simple stochastic discount factor, which is constant, and which is just defined by arbitrage or through the psychological discount factor. So we are in steady state. There is no aggregate uncertainty. So the discount rate is small r, where small r is the net of tax, depending on the papers, the net of tax return on safe assets. Since everybody's safe because the portfolio of stocks is safe, everything is safe. So, that's how they discount future cash flows. Okay. So the company at every date chooses not only its labor stock, but also the future value of its state variables, which is, you know, the future value of the endogenous state variables, or future value of capital in the next period, and also the future value of debt to be reimbursed in the next period. And as a result, what are the cash flows made of? Very simple. Here we have the free cash flows here. So the free cash flows are given by, you know, the profit, the sales of the firm, which depend on the productivity and also on the capital and the labor stock that are used. So it's KT, so there's a 1 period time to build. It's quite important in those models where you essentially decide on the capital stock 1 period ahead. That creates quite a bit of rigidity. And in addition to this rigidity in the capital stock, there's also, you know, an adjustment cost that we add in here. It's not that critical here. It ends up being small, but, you know, there's no reason to believe that it is exempt. I mean, the literature tends to find that it's quite small. As soon as you have time to build in capital, you don't need, I mean, in general, you know, that kind of already generates a lot of rigidity. Then, of course, you pay for your labor, you pay for your investment, that's the number of goods that you are using to reinvest. And also, you can borrow. So you can borrow by, you know, you can borrow a quantity DT plus 1 that you will have to pay back next period. And you pay down the debt that you borrowed in the previous period. So it's 1 period debt. In those models, typically, you know, debt is really, there's only short-term debt, just to make the safe state space tractable. And there's a prevailing interest rate, which is essentially, you know, higher whenever you borrow than when your debt is negative. So when your debt is negative, this is cash that you have, you know, and so you're lending your cash, and so we assume that the interest rate is lower in this case. So it's kind of, think of it as intermediation fees. It's actually important to have this. If you don't have this, then you will find that firms will have too much precautionary saving. Yeah. So firms will end up like having little debt or no debt at all. So you have this, and also you have taxes. So you have a tax system that turns out also to be quite important. It also encourages firms to borrow, and that's the standard, you know, US tax code, where companies, you know, pay taxes on their accounting profits. So that thing here is not cash flows, but it's really accounting profits. Okay, so accounting profits are sales minus, you know, wage bill, minus depreciation of capital, minus interest payments. That gives you the cost of, gives you the accounting profit, and then, you know, pre-tax profit, and then you pay a fraction small t of this. When it's negative, what we have, the version that we have currently of the model is really this one. So whenever accounting profits are negative, then you're receiving money from the government, which is reasonably consistent with the tax code in the sense that it's tax, you get tax loss carry forward. When you have negative profits, you're able to, you know, to carry them forward to a year where you're going to have positive profit in order to reduce your tax base. So that's reasonably realistic. So the two key elements here, okay, are the collateral constraint, and here I'm simplifying, but in fact we have a costly equity issuance in our baseline. In fact, now here this particular, we assume here that you know, here what I write down on this particular slide is that you cannot issue equity, you cannot have negative dividends. In the model, as you will see, we're just going to assume that, you know, whenever you have negative dividends, you just pay extra. That's going to be cost of equity issuance. That's how you model them. So that's important. It's important, you know, it's not easy to issue equity. And at the same time, it's not easy to issue debt. Okay, let's imagine you're in a world where you cannot issue debt, but, you know, it's costless. You can have costless negative cash flows costlessly. Then in this case, it means you can issue as much equity as you want at zero cost. Then in this case, you're not going to be financially constrained. So in order to be financially constrained, you need both constraints. You need to be unable to issue, or needs to be costly to issue equity and to be difficult to issue debt. So for that, what we have is the constraint. So how much you pay back has to be less than the value of your the projected value of your collateral, which is composed of capital K, the capital stock that you can sell back after depreciation, and so that's here, and the future value of H, where H is the real estate that you own. Just do some cleaning up here. Okay, so that thing here is the real estate. So you own H square meters, or H yards square, yes, feet square, and their price moves around time. And so if the expected price of your office space increases, then you can borrow more debt. So that relaxes the debt constraint. So you can see here how we're going to be able to match the reduced form moment whenever prices are higher. Okay, whenever the price of real estate goes up, you're going to be able to borrow more. Okay, and since it's hard to issue equity, then you can invest more. Okay, so that's
so David, in your reduced form stuff, if you had been regressing debt directly on real estate prices, then I guess you could have just uncovered S sort of very directly. But since you did investment, it's more of a moment to target than a parameter to just plug in. So try doing it away, or is there some reason to prefer one over the other?
No, there's no reason. That's because we were coming from the model where people look at investment instead of debt, but you're right, that's kind of the thought process led us there. However, we have debt. But we have that. We actually ran that regression. It turns out that we match it pretty well. So it turns out it's actually we managed to be consistent, even though we don't target this moment. I'm going to show it to you in a second. Yes, absolutely. Okay, any question on the model?
We have a question, David. Two, in fact. Let's see. They're in the chat, but I'm curious whether Anne would like to ask her question live.
Yes.
Sure. So I'm just asking this because I'm doing a thing on mortgages right now. So, but hopefully it's the right intuition. So my question is just, if your firms are borrowing instead of owning the property, is the effect just naturally the opposite, or do you have to consider something else?
No, it's a good question. So we never had that in the model, even though I think it would be the next step, and that would be an interesting one, actually. But I'm not quite sure exactly how it interacts and whether it meaningfully interacts with the model that with the mechanism we have here. Here, if you're renting your real estate, then you have no H, so you cannot pledge it. You're just renting it. So you cannot. So it doesn't give rise to additional debt capacity. Was that your question?
Yeah, exactly. It just seems like you have higher costs, so it would feed into something, but yeah, you're right, because it's all about expanded, expansion. Okay.
It goes into your cash flows, but not your debt capacity, basically.
Exactly. So it should go here somewhere in the cash flows. Yes, that's true. So that's if we were interested in knowing whether it's optimal to own real estate or lease it. And that would be an interesting thing to think about. Then we could actually have that here. The starting point is really to assume that H, you're born with some H, you have it or you don't have it, and that's it. Even though you might decide to own real estate in order to hedge yourself against situation where you are strapped for cash, but have meaningful investment opportunities. There are models like this that it might be. My gut feeling is that it's a bit second order, but maybe not, and it's worth thinking about it at least, for sure. Yes. Yeah.
Tyler, you have a question?
Mine was similar, David. Thank you. It was just about where H is showing up in terms of profits, but you already answered it. They're just born with the age and it influences their borrowing capacity. Thank you.
Okay. One more. Noemi,
go ahead.
Yes, thanks. I was wondering, so I understand that we're going to gain in terms of that this moment is going to be more robust to misspecification than targeting aggregate leverage. But I was wondering to which extent does this assume that all financial constraints are collateral constraints where collateral equals real estate, and may we miss on some forms of financing constraints that are not well summarized by collateral constraints?
No, that's true. That's not something we have looked at, and that's, I think, something I would be interested in knowing. I don't know how many people would be interested in knowing that, but I agree with you. That's not something we've looked at. So you can, for instance, try to address that kind of question by having a more complete model where you would have, like, let's say, two forms of constraints. One that is like related to cash flows, like in the Dan Greenwald paper, for instance, where he has that kind of model. Where there is cash constraint, or like in the one that they discuss in the Lian and Ma paper. So you can have the two constraints there and try to see whether the kind of mistake you're making. It's not even a misspecification we have explored. The reason being, I don't know why we haven't explored it, because it's not hard to do actually. But having this model that is more complicated and basically see whether that affects inference or not. I agree with you, or whether you would need an additional moment or yeah. Absolutely.
Thank you.
Okay, so let me show you the results and then have so so I think we have the model pretty much. We understand the model quite well at this stage. So the model is really, so it's 2005. It's NC1 2005 plus real estate. As I told you. You want, because it lowers your taxes, so you've got some trade-off theory dimension, and at the same time, if we have too much debt on, and it's hard to issue equity, and suddenly your productivity goes up, then you cannot invest, you're stuck, and that's the cost of having too much debt. So there's a dynamic trade-off. It's a dynamic trade-off model. It's very standard. So you're trading financial distress for the tax shield debt, and I'm gonna compare later on. Let me discuss this later. That's not important. Okay, so I'm gonna use various moments. Let me just be very quick on this because it's very standard what we do. We take the 1 year and the 5 year volatility of sales growth. In order to estimate the persistence and the volatility of productivity. That's fairly standard. Autocorrelation of investment is something that we use in order to estimate the adjustment cost parameter. That's also very standard. Whenever firms have investment that is very autocorrelated, then it means that that they're facing a convex adjustment cost, and they try to smooth their investment decisions over periods because they've got this quadratic cost of investment. So that's very standard also. We take the ratio of equity issuance to total assets to estimate the cost of equity issuance. So I showed you a constraint. I assume that you cannot issue equity. In fact, what we have is a linear cost of equity issuance, whereby if your cash flows are minus $1, what you're gonna pay is minus $1 minus $E. Okay, so per dollar of negative cash flow, in fact, your loss is not going to be minus $1, but minus $1 minus $E. Okay, so that's kind of, that's the cost. So typically, people think in the empirical literature, when you read the papers by, his name escapes me, the Florida professor, who's a specialist of IPOs and SEOs, typically what he has in mind. Yeah, J Rader, thanks. Yes. So J Rader would tell you it's between 10 and 20%, between 5 if it's a very large firm, 10 if it's a medium firm, and 20% if you're a very small firm that is going public for the first time. Anyway, so that's kind of the ballpark you should look at for E. And then, the key moment, Adam, is the reduced form moment we're interested in. Okay, so we solve all sorts of numerical issues. We make sure that we do our job well, and we have plenty of graphs to that effect. I think one that shows it here is this identification graphs, where we show how the various moments that we use to estimate the model depend on the parameter, okay, around the core, our baseline estimation. Okay, so our baseline estimation is here, that's the red line here, and each one of these charts is one moment, okay, as a function of S, which is the collateral parameter. Okay, remember, it's something like D is less than S times K plus H times P. Okay, so it's this S here. So we vary this S, okay, and we keep all the other parameters at their estimation, at their estimated level. And we vary this S, and we ask how that affects the moments that we try to target. So what we like here in this chart is that it's reasonably smooth. Okay, so that's, so it means that our grid size is, adequate, etc., etc. The only one that's not smooth all the way is our reduced form moment. And that's the one that requires actually that requires the most fine tuning in terms of the grid, the coarseness of the grid. So it needs a very fine grid actually in order to have like reasonably smooth variation in that moment. What you see here is that around the region that we're looking at, it's very smooth, so it's fine. So as S goes up initially, okay, the sensitivity of investment to real estate goes up. Okay, so as S goes up, if I regress investment on real estate, I should find a bigger and bigger coefficient. Okay, that makes sense. If real estate is more and more pledgeable, then whenever real estate is gonna appreciate, I'm gonna see more investment in response to that. Okay, but that's when S is small. So that means when the firm is constrained. Okay, at some point, however, the firm is not constrained anymore. Okay, there's so much S that whenever I get $1 of real estate, I have plenty of collateral. I'm never constrained, and therefore at some point, the more I'm gonna increase S, the less the company is gonna be constrained, and therefore the less investment is gonna be sensitive to real estate. So in fact, it's not. And it's actually a natural mechanism when you think about it. It's not monotonous. There's no reason why the investment to sensitivity to real estate is really something that is monotonically increasing the structural parameter. Okay, there's a moment after which, when the company is increasing, if the pledgeability of real estate capital goes up, at some point the company is going to be less and less constrained, and therefore its investment will stop depending on collateral shocks.
So David, it seems like you're getting a number for S that's like in the 0.3 range or something, but
that's right.
Typically,
yes.
you think that loan to value ratios are higher. Like if my house goes up by an extra $100, I can probably take out like $80 of debt on it. So the S that you're getting seems smaller than that. I'm just curious why.
Yeah, it's a good point. So there are various answers to that. So first, it's true for mortgages, like for individual mortgages. I don't know for firms whether it's the same ratio. What I know is that in general, for the capital stock that firms own, not all capital can be pledged at such high levels. Like for instance, if you think of account receivables or a movable collateral, the pledgeable, the S for these types of capital is much lower. So there's a paper on this by Calomiris and Laraine and the gang, Liberty and Sturgis. And so here, this S is really, it's so that that's where there is a bit of a trick here, which is that the capital stock here, is also going to generate some pledgeability. It's not just the real estate. And that's where we're being more structural here, because here, in a sense, we're assuming that there is the same level of pledgeability for both types of capital. and that's where getting 0.20 something, which is what we're getting, is actually reflecting, the aggregate capital of the company. Yes.
We have a question here from
Adriano.
Would you like to ask it?
Sure, I can ask it. Sorry, I think my connection is not good enough to put my video on, but I think my two questions is for those of us who do not normally engage with a lot of structural work. When you listed down the moments that you're targeting, you spoke as if it was very natural to pick those moments to target. I guess my question is there a natural intuition for, say, why we pick like the 1 and 5 year volatilities rather than, some different targets to pin down productivity parameters? I'm sure that the literature normally, uses the same moments to pin certain things, perhaps because, those are the things that are those moments that are sensitive to these parameters. So that's question number one. Any guidance would be nice. The second one is that when you wrote the collateral constraint, the S that we're trying to pin down is the collateral ratio, both for physical capital and real estate. So I was just curious, how does that compare to other estimates in the literature that do not include real estate? And how should we think about having different collateralizability of real estate versus, simple physical capital? I think that is also because, since real estate, I know here we're in partial equilibrium, but since real estate also depends on like prices, if we were to take this to equilibrium, then we would have like, asset price spirals for real estate, but not for physical capital. So I was just wondering if you folks had any thoughts on that. Sorry, that was a lot.
We do that these are excellent questions. So the second one is very close to Alexis' question in a sense, which is to say, okay, or at least that's where it led me, at least, which is that, it's true that here we're assuming that there is a single S for both types of capitals, and we're identifying the S on K in a sense from the S on H. That's I guess your question. Here we don't have exogenous sources of variation for the rest of the capital stock. So we need to have that in order to be meaningfully have both two different S's. It's worth looking into that though, because there is, I said, the Calomiris paper. The Calomiris paper has measures of loan-to-value ratios for the various types of capital that companies have, such as account receivables, cars, and stuff like this, movable and immovable capital. And perhaps that's a number we can take to look at these, even though, again, it's D over K doesn't have to be equal to S. So that's where there's a bit of a difference. But we could use the D over K1, K2, K3 to try to pin down different levels of S. I mean, I'm not saying it's impossible. We started with the the simplest possible model. So that's for your second question. For the first question, so I think it's interesting. Bottom line is, I think it's interesting to dig more into this. Maybe there's more to learn about this by having different. But you wouldn't enjoy, of course, the reduced form moment. For the first question, it's actually not completely standard to take 1 and 5 year volatilities. I don't want to get drawn into that, but at least it's an interesting discussion to have. What people typically do is that they compute productivity and then they regress it on its past, and then they compute the rho and the sigma this way. So they compute essentially, the persistence and the volatility of innovation. Looking simply by auto-regressing total factor productivity, regressing it on itself, or regressing log sales on their past. We thought that was a bit problematic in the sense that, and that's not the tradition. So that's a tradition we imported, the 1 and 5 year volatilities. That's a tradition we imported from the household finance literature, actually, that does it this way, which is that we're not quite willing to hang our hats on the DR1 model. So we don't quite believe in the DR1 model. We think it's a more complicated model, and therefore, looking at 5 year volatility will give us some kind of average persistent coefficient estimated over various horizons in a sense. And we think that's kind of more And that's more, it's also that it's hard to estimate that if you want to have heterogeneous levels of productivity across firms, which is something that we have here, regressing TFP on lag TFP, you've got a fixed effect and a lag in the same regression. So now you need to estimate, you need to have a GMM, you have to instrument for the lags, etc. And that becomes very messy, while those moments won't have this problem in a sense. That's why the household finance literature likes them. But that, I agree. I mean, that's a discussion we have in the paper. But you're right that, there are, okay, I'll get back to, which moment and to moment sensitivity. Sanjay had a remark that I'm going to share with you. Kermani and Ma does liquidation analysis for Chapter 11 US filings, and they find a mean liquidation value of PP&E to mean liquidation value of PP&E to book value of about 33%. So that's more or less in line with our S. Our S is not crazy, I think, to be honest. I'm going to get back to it. Okay, so let me just discuss this. Okay. So these are the numbers. Let's focus on this. Let's not, discuss the entire table. Let's focus on this part of the table. Noemi, is there? Yeah, go ahead, Noemi.
I wanted to ask on the, if you could go back one slide on the charts. I wanted to ask, are the slopes of these graphs in any way informative on to which extent each moment is informative about S? Put differently, my question was metrics that we can use to know which moments most identify which parameters, because I think that's useful to gain intuition on.
Absolutely. Absolutely. That's completely right. So what I'm showing you here, so the slope of these guys here around the SMM, that's so those slopes here, it's called the Jacobian matrix. So it's the derivative of the moments with respect to the parameters.
Okay.
And that Jacobian matrix, the steeper it is, in principle, the steeper it is, the steeper it is, the more precise the estimation is going to be. Okay. So that actually, if you look at the formula for the standard deviation, for standard errors of the estimated parameters, it is the inverse of J essentially.
And so here would there be a way to, because from the discussion on the intuition, we wanted S to be identified by the reduced form equation. Is there a way here to make sure that it's sort of only driven by that parameter and not driven, for instance, by how we modeled investment autocorrelation, which might be more subject to modeling error, while the steep on the third graph top row is actually quite large?
So let's defer the discussion to a few minutes. I have a slide on the specification, and the J matrix actually enters the discussion on the specification too. So that's absolutely. Okay, Shutao. Yes. You want to ask a question? Yeah, go ahead.
The SMM estimation, though you listed several moments to identify different parameters, overall it seems to be still very much like a black box. Maybe that's rude to say, because the variables there can relate everything to each other in the model. So my question is, suppose if you, based on your model, remove the collateral constraint, re-estimate the model by matching the same set of moments, will you be able to match those moments as well as in the model you have right now?
That's a great question, and I'm gonna get there.
Okay, thanks.
I'm gonna get there. That's how we're gonna discuss misspecification. Yes, absolutely. Okay. Yeah.
Okay, thanks.
Yeah. Absolutely. Yeah. I mean, black box, I agree with you. It remains black box all the time. At least if you're able to show this as a as a systematic online appendix or paper appendix to your readers or to referees, at least referees should be able to see those charts. That's kind of the basic minimum that they should be able to see, and then they can see whether that makes sense, the sensitivity, whether the slopes are easy to interpret or not, etc., etc. But I agree with you, it's harder, it takes more time in any case. But at least the authors of structural papers can pre-chew the work a little bit more for their readers, even though that still requires more time. Okay, so that's the model. So let me just, in the interest of time, let me move on just to discuss the magnitudes. That's the 23 that we have. So that's S. Okay, here. So S is equal to 0.23. The other parameters are less interesting. The one that we have here is the cost of equity issuance, E. So cost of equity issuance is about 15%. So if you issue $1 of equity, it's going to cost you 1.15. In terms of negative cash flow, you're going to be at minus 1.15 instead of minus 1. 15% is okay, actually. It's in the ballpark of equity issuance cost. It's not our finding, actually. Tony Whited has a paper where does this, and she find about 0.10, 0.15, something like that. So she gets to that kind of order of magnitude. When you try to estimate the cost of equity issuance, the way it's mostly identified here is through the fraction of the fraction of equity issuance to asset that we observe in companies, which is here. That's the moment that identifies this parameter. Anyways, that's a bit beside the point. It's just that we need to have some costly equity issuance in our model to make the whole thing work, and it's consistent with the data. More importantly is this here, this 0.23 that we're obtaining. Okay, so that's coming from the regression coefficient of investment on real estate, which is, if you remember the table that I was showing earlier, 0.06. Okay, so we have a different version of that regression in our paper where we saturate even more, we add even more fixed effects because people asked for them. We're still getting the same number, which is 0.06. That number gives you an S of, not that number alone, all moments contribute to S, but gives you an S of 0.23. The thing is, 0.23 is actually much smaller than what Midrigan and Xu use. So what Midrigan and Xu use is 0.80, something like that, if I remember correctly. Okay, so they use 0.80, which they obtain from aggregate Korean debt divided by aggregate capital stock of Korean firms. They use Korean data. And so 0.80 gives you an S of, so since they have a leverage, sorry, so their leverage is 0.80. So the MX leverage is 0.80. So they get an S of 0.90, something like this, even, because S has to be bigger than the effective ratio of debt to capital, since it's the maximum ratio of debt to capital that companies can have. And so with an S that is close to 0.90, we're in a world where there is no financing constraint left. And that's kind of, that's kind of the problem that they're facing in a sense. So their baseline model, then they have other versions of the baseline model, but in the baseline model, they have this 0.90, and that leads the reader to conclude that financing constraints don't matter unless you add those additional assumptions. It turns out that in fact, we're getting something that is much smaller by trying to target a much more meaningful, we believe, moment. So that's it. Yes, okay. And also there's the moment that Alexi was asking for here, which is the, no, not this one, sorry. This one here, which is the regression coefficient of debt on real estate value, and when real estate value goes up by $1, what we see in the data is that you're getting an additional 6 cents of additional debt, and that's what we have. That's what our model is able to reproduce here. So that's what the model reproduces, and that's what we have in the data. So that's a non-targeted moment that we managed to match. Okay, so that's the estimation, I guess, but that's not what we are after. Let me just keep this. So then what we're doing is that we're plunging this estimation in a GE framework, which is not fully GE, as one of you remarked, in the sense that the real estate market is not cleared, but we know, there are no households, they don't live somewhere, etc. So there's no consumption of housing services by households. So it wouldn't be very meaningful to clear that market. So the market that we clear is the product market and the labor market. Okay, so we clear the product market, we clear the labor market. Otherwise, we're talking about a stationary economy where there is no aggregate uncertainty. There's a representative consumer, etc. It's made as simple as possible. That we can solve easily. We don't even need to solve it numerically. We found out later. It's actually, there's no iteration. It's very simple to solve. Anyways. Okay, so bottom line is here is what we find. What we do here is that we reproduce. So that's the result of the paper. Before we start, we go to the specification discussion. The result of that paper, the result of the paper is here, where we essentially compute the log output loss. So here is output. Okay, and here is total factor productivity, which is the ratio of y aggregate output divided by k to the alpha L to the 1 minus alpha, where alpha is equal to is the alpha we choose, which is 0.3. So that's the aggregate productivity of the economy. And this thing here is a loss. So it's an output loss, and it's a TFP loss. What do we mean by this? It's the difference between the output of a simulated economy that has the parameters that we decide, and the output of an economy that would have no equity issuance constraint. Okay, so our unconstrained benchmark is an economy, a fictitious economy, and this is what our structural model allows us to do. Without it, we could not do it. Economy where cost of equity issuance is equal to 0. You can issue equity costlessly. So you still have the reason why we do this way and not comparing it, it wouldn't be that different actually. Rather than comparing it to an economy where S is equal to 1, let's say, is that in this world here, you still have the tax shield and everything. So it's easier to compare, it's all other things equal in a sense. It's easier to compare our economy as it is and the economy where you also have a tax shield, etc., and companies taking on debt to avoid taxes, etc. But at least they're not constrained. They can always issue equity as much as they want. So we compare the output and the productivity of these two economies, and that's what we show here. Okay, so it's the loss of having the constraint compared to having none. Okay. Okay, so let's focus on this chart here first. So here I'm looking at the value of S that is estimated, which is, remember, 20.23. Okay, the blue bar is really the confidence interval around the estimate. And what we see here is really the log output loss, which is somewhere, you know, which is estimated to be, if S is equal to 0, you lose from having S is equal to 0 and an equity constraint, you lose about 10% of GDP. Okay, so this is 10% of GDP. And from having 0.23, what you lose is about 7% of GDP. I don't know, it doesn't seem to match the forget about this because that's wrong here, that's written. I need to change those numbers. Okay, so you lose about 7% of GDP from having a constraint as we measure them. Okay, so it's not negligible. It's not negligible at all. If we were in the world of Midrigan and Zhu, that's where we would be. Okay, so Midrigan and Zhu, they would be around 0.9. Okay, so they would lose about 1%, which is, I guess, something which is somewhere around what they find. Okay, so essentially, you know, that's we're having That's what we find. Okay, so 7%, 4.23, and then you can do the so total factor productivity here. So the total factor productivity loss is here. It's about 1.2%. Okay, so for the S of 0.23, and if I was in the world of Midrigan and Xu, that's where I would be, and I would have a tiny total factor productivity loss. Okay, so what is total factor productivity? What total factor productivity measures is the extent to which the capital stock is well allocated to the right firms. Okay, if in a sense the total factor productivity loss is small when you impose the constraint, then it means that the company in aggregate will have less capital because it's harder to raise for company because it's harder for them to borrow, etc. But at least the capital stock will be lower, but the productivity of the economy will be the same. It will allocate the capital stock to the right project. Here we have a modest productivity loss of 1.2%. So most of this loss here is coming from not enough capital. Okay, so I could make a decomposition, which I don't have the exactly right numbers here, so I don't want to pollute your minds with the wrong numbers. But essentially, the capital stock is somewhere is lower by about 15%. Okay, then because there is not enough capital and not enough productivity in the economy is not very productive, and therefore the demand for labor is lower. And since the labor supply is a bit elastic, there's also slightly less employment also in the constrained economy. Okay, so employment is lower by about 1%, if I remember correctly, capital by 15%, and productivity lower by about 1%. Okay, so that's kind of the bottom line. I'm gonna put the right numbers before I send the slides to
David, just real quick, are all the firms pretty much constrained here in steady state, or is it the case that when one gets a shock, the other one can pick up the slack? You mentioned that before, and I'm just wondering if it's happening.
Yeah. So no, they can pick the slack from one another because they're operating on so first they're operating on the same labor market.
Mm-hmm.
So if I'm very constrained, I cannot be as big as I want. I have a too little capital, so I will not hire that many people. That will lower the wage. Other people will pick up the slack. And also on the product market, you have pretty much the same mechanism in the sense that these companies have a decreasing returns to scale. Let's put it this way. There's actually imperfect competition, but it doesn't really matter. But at least they pick up the slack of one another also on the product market. If I'm too small, then my competitor is going to produce more. No, absolutely, yes. Okay, so capital stock is too low by about 15%. Labor stock is too low by about let's say 3%. And TFP is too low by, I'm going to put the right numbers in the slides I'm going to send you after this. Okay. Okay, sounds good. Okay, so that's it. So let's now discuss misspecification a little bit. Perhaps I can stop now and discuss misspecification after. What do you think?
Yeah, if this is a natural time, we can take our 10-minute break.
I think so, yes. Yeah, I think so, yes. I think it's the right moment, yes.
Okay, great. Let's come back. How about 10:35? Does that sound good?
Yeah.
All right.
I can stay for a few minutes if some of you want to ask questions. I can stay on.
Sure. Thanks a lot. See you back 10:35, guys.
Yeah. Chutao, you have a question? Yeah, of course. Go ahead.
My question was about, I just wanted to be clear about whether there's the general equilibrium effect of the housing. There's no market for housing. And so I'm just wondering, how would that mechanism sort of impact the estimates that you've shown me? If you think of collateral channels, you usually think of if there's a market for real estate, it pushes up the price. which has a pecuniary externality on everyone, because then they do so those sort of mechanisms are missing. So I was just curious if you had any comments about, you know, what you would think if there were a general equilibrium effect.
To be honest, I don't quite see exactly how that's going to play out. So we have thought about it a little bit. I think what you would need in this case would be a household sector where people buy housing or not, I guess. Or you could make it a pure company thing. So then companies would need to have real estate. And then, you know, some companies would choose to lease it. Some companies would choose to buy it. I think it's hard to not have a model where companies choose to own or not own real estate, I think, in your world. So I would make the model significantly more complicated, and I'm not quite sure how big of a deal it is. So that's why we didn't think it was enough of a deal. I mean, at first, there was much to learn with the model as it is. But maybe there's something to learn about this. Like if everybody wants to hedge. Okay, something that would be okay. So the first step that I would take before actually going full on with this question would be to say, okay, how big is the hedging demand by firms? So if I allow firms to buy versus lease, you know, how much do they want to buy real estate for hedging? What is the hedging value of real estate from the viewpoint of firms? That's what I would try to estimate first. Is it a big effect? Does it have a big effect on firm value or not? If this is the case, then you know there's going to be a big hedging demand, and we have a material effect on prices. And then you know the two mechanisms are going to interact, and then it's going to be worth exploring or not. That's all I can say really about this.
Yeah, no, it's very complicated. I felt compelled to ask my advisors, Anna Fostel. So anytime I talk about collateral, I just had to bring it up, the GE. Thank you, David.
Thanks, Tyler. Yes, Shutao, go ahead.
David, so I have one comment or one quick question. The comment regarding the collateral constraint. So the coefficient for the value of S in a model is much smaller than that value in Midrig and Xu. I believe that seems to be very clear because of you have the real estate value there, and they don't have it. So that's to me seems to be a very good way to really get the estimate of S clear, because my own feeling is that the model is structural. Everything is kind of tangled together. How do you cleanly, relatively to identify S? In your case, you bring in the real estate. To me, that's very much. But then the question is still the comment. Then if you translate, I guess there's no way to translate because they don't have the real estate in Midrig and Xu's model. I guess I don't know. It's a bit I don't feel it's very much comparable in terms of comparing the degree of binding of the constraint between this model and Midrig and Xu. Right? That's just
their model is very but their model is very similar to ours, or you could say the opposite, or they're both similar to I mean, it's a slightly different model because it's from the macro tradition, so it has a few differences, but it's in the end quite similar. Again, I don't think that the market clearing of the real estate, I mean, let's put it this way. I think it's worth exploring.
I'm not thinking about indulgence in real estate. I'm not thinking about that at all. I think the way I like the way you did it really well, because you have to bring something that's we kind of think about the exogenous. You can make assumptions to justify why they can be exogenous. To me, that's fine. It's just a matter of how do we compare this with the other estimates by the paper you referred to.
Yeah.
Yeah. So the other question.
We should probably allow David a little break and pick up. We could have your discussion after the break. I'm just a little worried that
yeah,
not gonna get
fair enough. Yeah. Sorry. Yeah, go ahead.
Okay, that sounds good. Thanks, Alexi.
We'll come back.
We can discuss
Oh yeah,
it after the.
We'll get to it. Don't worry.
Sure.
Thank you. Okay, I think we're back right on time.
Okay, great.
So pick up where we left off, David.
Yeah, absolutely. So so let's move on to the discussion on misspecification, which is something that we think is also value added of this research. So how to explore the lack of robustness of a structural work in a sense. So let's discuss structural robustness checks. So so let's start with the moment that we chose. Okay, so as I told you, 100% of the existing literature targets the mean leverage ratio. So you're basically computing the mean D over K in your simulated panel, and you're asking this mean D over K to be equal to what you find in the data. It seems much simpler than running complicated regressions. I guess this is why it's so popular. However, of course, in fact, there are several problems with leverage. The first one is that it's actually much harder to compute than what you could think. In fact, what do you include in leverage? What do you include in debt? So debt might include some debt that is unsecured, in which case the model is misspecified. You know, that's debt that is not that does not need a security. Collateral. What are the operating lease commitments? The pension liabilities, capital. It's complicated too because there are, accounting depreciation is very different from physical depreciation. So capital might depreciate more slowly than what accounts seem to suggest. Should you add the operating leases as part of the capital stock, as some papers do, but some others don't? How do you deal with intangible capital, etc.? So I'm going to discuss a few alternative definitions of capital and debt and see how they affect leverage. But before I do that, let me just discuss, and that's going to tie into one of Noémie's questions earlier, which is how we can explore misspecification in a model-free way. So this is not us. This is Andrews, Gensko, and Shapiro. It's a paper that people cite very often. And I thought it was worth, spending, one slide, and that would hopefully answer some of Noémie's questions and other questions that arose. So in that paper, what they say is this. It's very simple. What they say is, let's assume that there's a true set of parameters, theta naught. Okay, so there's a true parameter theta naught. Okay, and a true model that uses those parameters to generate the data. And an econometrician is gonna use the data to compute empirical moments, m hat. Okay, so these are those m hat are the empirical moments. So you take your data, you get those moments. And now let's assume, and that's where we're talking about misspecification, that an econometrician is using the wrong model. And this wrong model, let's call it capital M of theta. That's a function. It maps a set of parameters theta into capital M of theta, which is a set of moments. Okay, which are the moments that they try to match with the data. And so what this econometrician tries to do is to estimate theta hat to match the empirical moment. So that person tries to find the m theta hat that is the closest possible to the empirical moments in the data. But that model is the wrong model. It's not the right model. Okay, it's a model that the econometrician is using. Then in this case, I spare you the algebra. It's very simple algebra. You can do it yourself at home while watching TV. What you find is essentially that in the neighborhood of theta naught, which are the true parameters of the model, the difference between the estimated, so the misspecified, it's the misspecified, it's coming is the theta hat that's coming from estimating the misspecified model, okay, and the true theta, so the distance between the bias, really, it's really the bias of having a misspecified model, is going to be a function, a direct function of something which is the difference between what? Between the true moment, the data moments here. Okay, so the empirical moments that you're looking at in the data. So they're generated by the true parameter theta naught and the true model, which is not capital N, it's a different function. And what the moments would look like if you were to use the wrong model, but the true parameters. Okay, so it's essentially saying, let's look at the data moments M hat, and let's remove from these moments the effect that belong to the true model, but not to the model I'm using. So the unmodeled forces of the real world. So that thing is really the unmodeled forces. The effect of unmodeled forces on the moment. Okay, so if I was to remove so if I take the true parameters, but I remove from the real world the forces that I don't model in my own model. Okay, so that's how. So this is what you see here. Okay. Okay, and that is you have to multiply this by a sensitivity matrix. Okay, so what is this sensitivity matrix? W is the weights that are used in the SMM estimation. So you can think, for instance, of W as being identity matrix, for instance, or whatever W you want to use. So essentially what you have here is something that is very close to being something like the inverse of J. It's the generalized inverse of J. Okay, so J is not invertible; it's not a square matrix, but it's essentially the inverse of J. So what it tells you is that if you look at your moments, okay, so the AGS intuition is this; it's very simple. It tells you if you look at your moments and you're saying, okay, let me strip those moments from all the forces that I don't model. Okay, will they change a lot or not? Okay, and if those moments are very strongly affected by non-model forces, let's say leverage contains a lot of income smoothing by entrepreneurs, for instance. So that's what drives leverage much more than financing constraints. Then the true leverage I should be using is not the leverage I see in the data, which is say 0.3, but I should be using much less, let's say 0.1, because there's only 10% of that leverage that corresponds to true measure of financing constraints. Or I should add, perhaps I should add this leverage, whatever is, whatever direction the thing goes. So then imagine that I think that leverage should be very much affected by unmodeled forces. Then I should ask whether my parameters are very sensitive to leverage. If parameters are very sensitive to leverage, then it's a problem. Okay. If they are not very sensitive to leverage, even if my leverage is polluted by these non-model forces, then it's not a big deal because it doesn't depend on leverage. And this is where you see kind of the circular logic here. In fact, whenever the J matrix is going to be large, okay, so whenever the sensitivity is going to be low, the moment is not going to contribute a lot to identification. And then, because it doesn't contribute a lot to identification, whether it's misspecified or not, it doesn't really matter because it doesn't really affect your parameters. That's AGS, really. Okay, so AGS tells you, okay, if the moment doesn't really affect the parameter, then we don't really care that the moment is contains a lot of misspecified forces or not. Okay, so it's a bit, it's, you know, I mean, it's an interesting thought, but you know, that's all there is to it. So it has, okay, so that's very simple. The problems with this approach is that, I mean, there are two problems. The first one is that thing is asymptotic. So what it means, it's not just asymptotic, sorry, it has to be the case that theta hat is not too far from theta naught. So you cannot operate in a world where you're like grossly misspecifying. So you have to assume that your model is pretty good, okay, in terms of estimation. So that's the first problem. So it's very local. And the other problem is also a problem, which is it's not quite clear. You have to take a stand at how your out of model forces affect moments, but that you don't know. Okay, now it's hard. It's very, very hard to tell. You know how much out of model forces affect moments or not. You know, you have to. You know, I mean, you never know. Maybe it's not very sensitive to leverage, your estimate of S, but maybe leverage is overestimated by a factor of 3 because of all the forces that you didn't include in your model, and that you don't know unless you take a firmer stand on how misspecified you are. So it looks like it's model free, but in fact, it requires a lot of hidden assumptions everywhere. Okay. So, okay. So we do compute actually the sensitivity matrix in our setting. And here you have that, in fact, if you look at, let's say, total factor productivity, the sensitivity of total factor productivity with respect to leverage is 0.04. And the sensitivity of TFP loss with respect to the reduced form coefficient is 0.02. So it's a bit smaller. So it turns out that indeed, but it's a bit less sensitive. So from the viewpoint of AGS, you would say, okay, you're in good shape, your moments, the estimates are less sensitive to your moments. But you don't know, maybe specification. I mean, our argument is that misspecification affects this moment much more than the reduced form moment. Okay, so again, just to repeat, the bias on theta is equal to sensitivity, so they call it the lambda matrix, multiplied by the bias on moment. Okay, so we're seeing that indeed the lambda matrix is a bit smaller with respect to sensitivity is a bit smaller with respect to leverage to our moment than leverage, but more importantly, we think that our moment is much less biased by out of model forces than leverage. Okay, so let me try to argue it in 2 ways. The first one is just very descriptive by looking at the various definitions of the leverage ratio that have been used in the literature. So we don't do anything fancy here. We take existing papers, actually structural papers, many of them, and we define leverage the way they define it. Okay, so there are various ways. So there's the first standard thing, which is to divide property, plants, and equipment, net of depreciation, by total assets. Okay, so that's kind of the first way to do it. Very simple. You have a view of capital that is very physical. You compute the machines, you divide by the total assets, including real estate and account receivables and things like this. You do this, you find a leverage over total assets of 0.9. That's what you find here. Okay, and then you run variants of this. Okay, so you include intangible capital. There are ways to do this. That are considered standard in the literature, when you take R&D that you accumulate and you depreciate it, etc., using the perpetual inventory method. You can include leasing, operating leases. There are various ways you can either compute the book value of operating lease or the present value of operating lease which is something that, you know, people have done in the literature. So that's why we're doing it these two ways. You can decide to include account payables as, you know, part of debt, because this is debt to suppliers. You can also decide to change the depreciation rate instead of using the accounting depreciation rate, which tends to be pretty high. We can use, you know, a more standard depreciation rate, which is closer to what macro people use, etc., etc. So we can make all these changes. And what you see is that leverage is a bit all over the place. When you introduce intangible, it goes down, not that much, that's fine. But then when you add leasing, then it doubles. But it depends on how you take leasing. If you take the present value of leases as a measure of debt, then it becomes again lower. If you include account payables, that also increases leverage quite a bit, of course, because you're adding additional debt. And also when you change depreciation, that affects also the ratio. Bottom line, if you do all those adjustments together, you end up with a leverage ratio that is twice as big as the baseline leverage ratio. Okay, so now the question is, how does it change our thing? And it's true that it also changes our parameter. But if you look at the variation of our parameter, it varies a little bit less. Okay, so we make these adjustments, run the regression, look at the slope. Okay, there is also quite a bit of change, but you know, much less than with leverage ratio. Okay, so that's one thing. Okay, but of course it doesn't, you know, settle because in the end we don't quite know exactly how to specify it. So it's a point to say, okay, people believe that leverage is so much better than, you know, any kind of regression result because it's, you know, there are few assumptions. You just compute an average. It turns out that even the corporate finance literature tells you that there are many ways to compute it, and that it actually has quite a big impact on the moment. So the moment is kind of variable. So leverage is a variable moment, at least as much, even slightly more than our thing. The other way to approach these robustness checks here is to do what we call a structural robustness check. And how do we do it? We actually start from the idea that, you know, maybe our model is not correct in several dimensions, and we specify those dimensions. Maybe, you know, there is intangible capital that we don't measure in our leverage ratio, maybe, and in our regressions. Maybe firms have tangible capital, but it's underestimated because of excess depreciation rate, like accounting depreciation being too high. Maybe it's because firms have fixed unsecured debt capacity that we didn't put in the model, but that exists in real life. Firms have unsecured debt that they use. Okay, it's not in our constraint. Maybe firms have secured debt, but secured debt is not well measured by the econometrician. That's the whole thing on operating leases. Okay, that's secured debt in a sense. An operating lease is a secured debt that is not measured by the econometrician. Maybe the real estate value itself is mismeasured, which would hurt our moment and not so much hurt the leverage moment, etc., etc. And we have a few more. Okay, so what do we do? We have all those dimensions in which our baseline model is misspecified. And so since we don't know the extent to which, you know, that's true, we draw various parameters from these, how many of these? 7 parameters here. We draw these 7 additional parameters, simulate various models, 1,000 of them, and we estimate each one of these models with our baseline model, which is misspecified in this case. Okay, so we specify those alternate universe where, you know, the world is not exactly like in our model. There is intangible capital, there is non-measured debt, etc., etc. So this is parallel universe. In those simulated data, we estimate our baseline model, which is wrong. And then we ask, you know, is it the case that the total factor productivity that we obtain by estimating the wrong model is very far off the total factor productivity that's you know the true total factor productivity. So we can measure the difference because we know the true world. In those alternate universes, we know the true world because we simulate them. So we know the total factor productivity loss coming from financing constraints. And so we're asking, are we wrong? Are we far off or not? Depending on whether we target leverage or we target our moment. Okay, so that's what we do. We estimate our baseline model on each one of these economies. Okay, so these economies are the baseline world plus, you know, additional sources of misspecification. These 7 guys here, mismeasurement, etc., of real estate, etc. So in each one of these economies, we estimate our baseline model. So our model is just misspecified, of course, because those economies are different. And, you know, we try 2 ways of estimating it. Either we target leverage or we target the reduced form moment. And then we ask whether we're further off by targeting our reduced form moment or by targeting the leverage. The challenge here, and we are writing a follow-up paper on this where we look at this in detail, is that it's actually hard to do. So that's why people don't do it. So so it's a natural robustness check. It's exactly like when you're sitting in a seminar looking at a diff paper and you're seeing, oh, maybe there's this other thing going on and that explains the result. So here, that's exactly what we're doing. We're saying, oh, maybe there's this other thing going on. Let's say depth is not well measured. Okay, and then how much would that affect the result? And then we're asking whether that's the case or not. Okay, so it's really a robustness check. The reason why people don't do this is that it's painful enough to run one SMM estimate that you will run like 1,000 of them. Okay, that's actually not possible. Why? Because estimating our model already, and we are already using GPUs, etc. It's parallelized to the max. It already takes us about a week. So now, if we are to like estimate this 1,000 parallel universe in a week each, it would not be possible. So the solution we explore, and we're actually having a following paper on this, is to use a surrogate model. So the surrogate model is this. So it's something that people know about, in particular in physics. There's also a paper by my colleague Chen on this in asset pricing, where essentially what we do is very simple. So we take our baseline model. We draw 10,000 parameters. I don't remember exactly how many we took, but something like that. So large number of parameters. And for each one of this set of parameters in the baseline model, we simulate the moment, MI. So I is one simulation. So there are 10,000 simulations with different parameters, the parameters of the baseline model. So it's not misspecified, it's really just the model. And then what we do is that we actually compute a function that ties parameters to moments. And we try to compute a simple function. It's like a polynomial. Think of it as a polynomial. There are various ways of doing that, but there's essentially a polynomial that maps, the parameters into the moments. We've got these 10,000 observations of parameters with moments. That's very easy to do. It's just 10,000 simulations. It goes very fast. Once we have those simulations, it takes perhaps 1 day or 2, but you just do it once. And then you compute the mapping between parameters and moments. And then, once you have this function, think of it as a 2nd order or 3rd order polynomial, then it's just very easy to just invert it. Invert it, quote unquote, because it's more like a minimum distance estimation, but it's very quick to do because it's very smooth, so it's extremely fast. And so now you give me any set of moment m hat, I'm gonna find very quickly the theta hat that corresponds to those moments, but based on the surrogate model. Okay, so we've got plenty of results in this forthcoming paper where we're showing that in this about to be written paper where we show that it's actually a good way to do it. So that's how we do it, and that's how we achieve this ability to do structural robustness checks. The result is this. It's right here. It's very simple, and it's just that one slide. The reduced form moment it turns out to be more immune to misspecification. That's we are happy to see that. So what is this here? So that thing is for output, that thing is for TFP. So you can just watch one. Let's just watch a total factor productivity, for instance, here. And total factor productivity here is really just what we're showing is the distribution of the difference between the total factor productivity that's estimated using either moment or reduced form, either leverage or reduced form moment estimation, minus the true TFP. In each alternate universe. So I have 1,000 alternate universe. I know the true TFP loss of financing constraint. I can estimate my wrong model, find out a TFP loss, compare the two, do it for each one of this alternate universe, and look at the distribution here. So what you see here is that when you target leverage, first tends to be biased, but more importantly, it tends to be flatter. So the estimation of productivity is more all over the place when you target leverage than when you target the reduced form moment, where it's actually the distribution is thinner. Okay, there's still problems with our moments. The problem is that our reduced form moment is of course polluted by misspecification. Of course it is. Okay, but less. Okay, does it have to always be the case? I don't know. But the bottom line is that here there's a method to do easily robustness checks. Okay, questions, and then I can move on to the other paper.
Any questions? Yes.
Noemi, go ahead.
Sorry, because this is going back to when you presented the results, but I wanted to know if you could provide some intuition on why the effect on input usage and in particular capital is so large, but the effect on misallocation is relatively small. I had some intuition.
Yes, I don't know. To be honest, it's really measurement. I think the idea, what's going on, let me put it this way. We haven't really checked. I mean, I would be interested to explore this a bit more in detail. But I think what I'm going to give you is the Ben-Moll intuition, 2014. So it's essentially, dynamics thing. So we have a Cobb-Douglas technology, which is very convex, and it has, it's really, it has a infinite productivity when capital with zero capital, and then it goes down. And so essentially what we have is that firms, even when S is equal to, one way to see this is here, okay? Okay, so let me just erase all this, just to make it a bit clearer. Here, when S is equal to 0, the output loss from financing constraint is only 10%. It's slightly less than 10%. So it's not very big. Okay, so firms can get away with like super binding financing constraints. It's not such a huge deal. You can save your way out of constraints essentially, and so that's I think what's happening here. And so then it's a competition between how fast productivity mean reverts when you have a positive shock, and how long it takes to have enough savings to basically be productive. And here it looks like, it's persistent enough, productivity is persistent enough. You have a positive shock, and now you need more capital. You don't have enough because you're too small. It takes a while to get there, but once you get there, you're going to enjoy, this high productivity and lots of capital for a long time. And so that, I think that looking at this using actual data on firm dynamics is actually interesting. I mean, there's more to do on research on this actually.
Okay, thank you. Related to this, I was thinking maybe another intuition is that the S is driving the average wedge in the language of the misallocation literature, the dispersion.
No,
a high average wedge, but then
I see what you mean. So the average, okay. I don't think I mean, it's not automatically the case in the sense that, it really depends on how fast productivities vary. So it's true that if all firms were the same, you would be right. But since they are not, if productivity varies all the time, then, it will vary. It will affect the distribution of wages, not just the mean.
Okay. Thank you.
Okay. So let's now move on to this paper, which requires an hour. I have a short presentation, so I hope that an hour is going to be enough. It's a 20 minutes presentation uninterrupted, so I think that's fine. And so that paper is another paper with Sraer that we've been writing. Took us about 6 years, and we're slowly getting there. It's a paper that discusses, resource misallocation. Okay, so we have just discussed resource misallocation with Noémie, actually, so it's a good segue into this. That essentially, maybe not the right firm have the right amount of capital. So capital is not into the hands of the right firm, capital or labor or any kind of input. The misallocation of resources has been, in applied economics, a generic motivation for free market reforms. Okay, so let's call the Washington consensus, so to speak. That's what they were pushing for. They were saying, oh, you need to liberalize capital markets because otherwise it's the wrong firm who have the capital. Okay, it's a bit also transition in, economies from Eastern Europe. It was very much the topic, like lots of companies have too much capital, others don't, you need to let the market for capital work better. So that's been behind the proposals of various bodies, including, including the 2DC, the IMF and the World Bank, but, many others to push for financial liberalization, bankruptcy reform also, that's also a big motivator behind bankruptcy reforms, capital tax reform, you need to tax capital in a way that, makes, capital allocation optimal, but it's also beyond the capital markets, and that's beyond free trade. So the reason why you push for free trade is that some countries have comparative advantage at producing stuff and others have comparative advantage of producing other stuff. And that, reallocation of factors across a country is really of production across countries is gonna generate welfare gains. Antitrust is also all about misallocation. Monopolies are too small. Zombie firms, also the current debate on whether is COVID help to SMEs gonna create zombie firms or not. That's also a misallocation debate. So there's lots of misallocation debate, but it turns out we haven't been trying very hard to quantify misallocation until a few years ago. That's kind of the surprise. Okay, how big is it? How big a deal is it? That there weren't that many papers until recently. I think kind of the one that kickstarted a lot of this research. There are others, with Richard Rogerson, etc. But is the Scientino paper, which essentially, so that's the one Noémie was alluding to, which is essentially using a sufficient statistics approach. And I'm going to get back there, but the idea is to say, let's compute the variance of productivities of firms across firms. If there is a big variance of productivities, it means that some firms could enjoy more capital because their productivity is very high. So they should have more capital than they currently have. And some firms have low productivity, meaning that they have too much capital. So you should take the capital away from the low productivity firms and channel it to high productivity firms that would increase aggregate productivity of capital. So that's kind of the idea. So they have like the sufficient statistic approach. So you compute the variance of productivities, and that will give you, the extent of misallocation. This approach has issues that have been pointed out in the literature. One is that, productivities vary sometimes for good reasons, that, you have real friction. Some firms have too much capital, but it's really hard to reallocate the capital. There are adjustment costs, essentially. You have measurement error also. So maybe some of the dispersion in productivity that you're seeing is coming from the fact that you don't measure it well. That's all, it's not that, marginal productivities are different. They are the same in real life, but you measure them to be different because you're not good at that. And it's hard we don't know much about production functions. I mean, we do know a lot, but we don't measure them well, let's say. So. And there's also the idea of policy relevance. So policy relevance is what is politically feasible in terms of reducing productivities. Let's imagine you have productivities, that are very dispersed. So that means a lot of distortions. But maybe it's impossible to shrink this distribution of productivities for various reasons. Maybe it would be immensely costly, etc. So there are an issue of policy relevance. Okay, so these are the issues that have been pointing out in the literature. So there's an alternative, again, okay, talking about the two traditions that I was mentioning earlier, is to go structural. So if you go structural, it's very simple. So many papers have done this, Mijugan and Zhu that we have discussed before, or David and Venkatiram, for instance. And there's the two various papers by Joel David and Venki. Have actually, tried to say, okay, let's write down a model with a friction, a bit like what we did in the previous paper, exactly actually as we did in the previous. Let's write a model with frictions. Let's measure those frictions, okay? And then, let's see whether when you remove those frictions, how much you would change the aggregate output of TFP of the economy. Exactly what we did. So what these papers do, actually the problem with these papers, and that came up in the Q&A quite a bit, is that of course you need to take a stand. First, you need to identify the key friction well, okay? So that's, you need to be able to know what they are, and then you need to write down the model, okay? And that's kind of the questions we had. What if, for instance, there is no collateral constraints are not such a big deal, and it's more cash flow constraint that firms are facing, or other constraints, okay? And so that forces you to take a stand. Why not? Actually, I mean, it's totally legitimate as research, but it's you need to make. So basically, what I'm going to propose is a way to solve these two issues at the same time, to kill two birds with one stone. Okay, in a joint work with Sri. Okay, so here is what we do. We combine the large applied micro literature. So how do we do this? We do this by combining the large applied micro literature that's evaluating effect of policies on firms with a sufficient statistic approach a la Scientlino. So we do both. We use the sufficient statistics approach a la Scientlino. Combined, so the problem with Scientlino is that people said, okay, you compute the variance of productivities, doesn't mean much. So essentially what we're going to do is a difference in the variance of productivities. And that will take care of a lot of problems. That's what I'm going to show. It will help me measure misallocation. And the advantage of this methodology is twofold here. First, it is not subject to most of the criticisms of the Scientlino literature. So it will deal with some of the issues of the Scientlino literature in the sense that it will not have a problem. Real frictions are going to be dealt with. Measurement error is going to be dealt with because I'm working in a different world. So that's give me. And policy relevance is going to be dealt with. And at the same time, it will be equivalent to doing structural estimation. So the beauty of this is that this method, which is essentially Scientlino, because it's a sufficient statistic method, essentially, it's equivalent to estimating a model without estimating it. So I don't have to take a stand as to how this model is written. As long as it belongs to a large class of model that I'm going to write down explicitly, I'm going to be in good shape. I'm going to be able to do my thing. And then I don't need to take a stand as to how exactly it is written as long as it belongs to this large class. So it's like a structural stuff without going structural. So you lose some of the virtues of going structural. For instance, it's hard to run counterfactuals, but you can do a little bit, and that's what I'm going to discuss. Okay, so let me describe the method and the challenge. So I'm going to describe the method. So if you want to stop here in a sense and see the method, then I'm going to explain why it works, but in a sense. method is here. So that's the slide where I describe the method in a nutshell. It's very simple. So assume you have firm level data and a quasi experiment. Okay, for instance, I have an explication that I'm going to show you, which is the French banking deregulation of 1985. I have an old paper where with Marianne Bertrand and Antoinette Shaw, we were looking at the French banking deregulation of 1985. Let's imagine that's what you have, and you have a panel of French firms. You can follow them before, after. You can, and you have treated firms and controlled firms, firms that are not affected by the deregulation, firms that are. Okay, so let's think of it as financial deregulation, since this is the. But it can be a tax reform, it can be a bankruptcy reform, etc. It's widely applicable. And then the question is how to quantify the effect of the experiment on misallocation. Okay, so now I want to go back to this period of the 1980s in France. It was a big bang, really. It was like the big bang in the city, but it happened in France. This very far-reaching banking deregulation. And the question I'm asking now as an historian of economics is to say, okay, that's a policy that can be implemented. It's very simple. It has there's a guidebook. By how much did it affect misallocation? Okay, so let's say measured by total factor productivity. So by how much did it increase total factor productivity? That's the question I'm asking. The paper has more stuff, but let's not discuss them now. Let me just mention this here. There's an alternative here where you could also ask how an experiment would scale up. So that wouldn't work with the banking deregulation, which affected the entire economy. So there's nothing to. But let's imagine, for instance, that you observe that lenient judges manage to save more bankrupt firms. Bankruptcy judges, when they're supposed to deal with bankrupt firms, many more of them are saved and continue to live and grow, etc. And so the question is, what if you were to apply the standards of leniency to all judges in the US? Okay, so that you scale up. So you can observe, the effect of your experiment on a small subset of the economy, the companies that were fortunate enough to be dealt with by lenient judges, bankruptcy judges. And now let's imagine, so what you want to do is a scaling up where you say, okay, what if we were in a world where all the companies in the US that are going bankrupt can be dealt with by lenient judges. Okay, so that's a scaling up. It's different. It's a small experiment that you want to scale up. And that we can deal with also. The paper can also deal with that kind of thing. Okay, so I said it. Now forget it. Let's think about an economy-wide reform. So I have this economy-wide reform. And I have the data, I can study it, and I want to compute the effect of the reform on TFP. So what we recommend is a two-step method that is very simple to apply. It's essentially a diff in diff with an aggregation formula. Okay, so very simple. So the diff in diff is very simple to apply. So essentially what we do is that we go we compute the variance of the log sales to capital ratio in the treatment and in the control group. Okay, so we've got a set of firms that are treated, a set of firms that are the control group. We compute the variance of the log sales to capital ratio, which is the marginal revenue product of capital, or, it's the productivity of capital, think of it this way. So we compute the variance of this measure of productivity of capital in the treatment before, after the experiment, in the control before and after the experiment, and look at the definition. Okay. So if the experiment improves the allocation of capital in the treatment compared to the control, then we should see that the variance goes down more in the treatment than in the control. Okay, so the variance of productivities shrinks in the treatment more than in the control. So that's the diff in diff that we obtain. So once we obtain this number, which is a diff in diff invariant, Then we just inject it in a formula. So here I have an aggregation formula that is the simplest possible, which is the same as the economy we had before. Identical firms, decreasing returns to scale theta is less than 1 measures decreasing returns to scale, and alpha is the capital share. Okay, but then you can have like slightly more complicated economies where you have an input-output network, where you have heterogeneous industries and stuff like this, you know? Okay, but if you have this simple economy, you know, you can just use this number. It turns out it doesn't make much of a difference, actually. So essentially what you do is this, it's very simple. You take the variance, treatment control, compare the evolution, okay? And then, you know, multiply it by something which is your aggregation model. So that model you have to take a stand on, you cannot identify it, that's an assumption you're making. You're assuming how firms interact with one another. That's your macro assumption. And then you obtain the effect on the TFP. So it's very easy. So I'm gonna explain to you why it's an issue and how we deal with it. Okay, why it's not obvious that you can do this in a sense, because that's really Scientino in definitive really. That's really, it's like you take Scientino, you do the definitive version, that's really it. So why it's not obvious that you can do it? Okay, so why there needs to be some work there, and then I'm going to apply it to the French banking deregulation of the 80s. Okay, but first let's look at why it's not obvious and why you need to do a little bit of work. Are there any questions at this stage? Okay, no questions. Perfect delivery. Okay. Okay, so it's the Scientino definitive, if you want to remember it this way. Okay, so why does it work? Okay, so let me sort of, you know, write things a bit more clearly, even though it's going to be simple. I'm going to stick with a simple model. I'm not going to show you the full Monty. Okay, so imagine that you're an econometrician. You have firm level data and an experiment. And your goal is to measure the pure effect of the experiment on total factor productivity. That's what you want to do. Okay, French banking deregulation, how much did it increase French CFP? Okay, that's your question. Okay, so let's assume, let's take for this purpose a very simple aggregation model. As I told you, you can make it more complicated. Not clear it's gonna help, but you know, you can make it more complicated. We offer guidelines in the paper, very simple. It's not much more complicated actually, but let's take a simple aggregation model. You have a continuum of firms, okay? And there's a CS aggregator, meaning that aggregate output here is gonna be equal to the sum of individual outputs of all firms, okay? And theta is less than 1 here. Okay, so it means it's imperfectly substitutable. Okay, you cannot substitute very easily, you know, the outputs of firms. So if one becomes less productive or doesn't have enough capital, you know, there's going to be some slack that's going to be picked up by the other firms, but not fully because they're not perfectly substitutable. You need that, and that's important to generate misallocation. And then I'm going to assume also that production technology of each firm is going to be just Cobb-Douglas. Okay, let's make it simple. Like, it cannot be simpler than this. Firms can have like different productivities. They can have the same one, whatever you prefer. The reason why I keep the ZI here is that the average firm needs to be some steady state assumption there. Okay, so we're in the steady state. We're thinking about long run effects. So here, then in this case, it's always true. So that's, you know, going back to Scientino, that's not our invention. In an economy like this, I didn't tell you, you know, what kind of constraints companies were facing, whether they were financially constrained, whether they were facing adjustment costs of various sorts, you know, and all sorts of things that firms may face in their real life. I didn't say anything about that. But it turns out that those firms, you know, whether those firms are facing constraints or not, and whatever the kind of constraints that they're facing, the aggregate productivity of this economy is always going to be given by this formula right now. Okay, that's not our invention, it's Scientino. Okay, So Chientino write those constraints under the form of a wedge, etc. But it's always true that the aggregate productivity of this economy is going to be equal to something which has alpha and theta in there. So when alpha is bigger, capital is bigger, and if there are more distortion in capital, it's going to matter more in terms of aggregate productivity. Times the cross-sectional variance, that's why you have excess here, it's cross-sectional. Okay, the cross-sectional variance of log to sales to capital ratio. Okay, so that's always true as soon as you have Cobb-Douglas and the CS aggregator. Whatever are the constraints that prevent firms from doing what they want to do. Meaning that here I have 99% of macrofinance models, at least long-term ones. Long-term ones, not short-term ones, long-term ones. So that's always true. Okay. So the bottom line is that, of course, TFP is bigger. So that's Chientino. TFP is bigger whenever capital productivities are more aligned, whenever the variance is smaller. Okay, there's a minus here. So whenever the variance is smaller, TFP is bigger. Okay, if all marginal productivities were equal, total factor productivity will be 0 here. That's the normalized level of productivity. Okay, and if it's not equal, then total factor productivity will be lower. It's important, I said it many times, but it's important to note that this formula is true even with complex frictions. It's always true. Okay, the formula is always true, as long as you have these assumptions. Okay, so now let's introduce the experiment. So the experiment, to make things as simple as possible. It has half of the firms are treated, half of the firms are the control. So you've got 2 types of firms. So now you can write down the pure effect of the experiment. So you have to do some algebra, not much. It's very simple, but you start from this, and you essentially differentiate. The aggregate effect, so the pure effect of the experiment on total factor productivity is going to be this thing here, times the sum of 2 things. You have 2 effects. The first effect is, let's look at the second term first, is the differential effect. So it's the difference in difference that I recommended that you compute. Okay, the difference in difference of the Chientino sufficient statistic. Okay, so it tells you, for half of the firm which are in the treatment, those firms have their variance that increases more than the control. So the treated firms have their variance increases more than the control. And if that's the case, it's going to hurt, aggregate productivity. And it's multiplied by 1/2 here because it's, it's just 1/2 of the firms are treated. So the other ones are not. And of course, you've got the baseline effect, which is that the control group is going to be affected. Since you're treating the treatment, then of course, treated firms are going to behave differently. It's going to affect the entire economy, and it's going to feed back into all the firms of the economy, both the control and the treatment. So it's going to have a baseline effect that is going to be affected. It's something that some people call the missing intercept. Okay, there's a paper by Kobe and the co-author on the missing intercept. So that's the missing intercept. Okay. Because I'm going to imagine now that, what I see in the data is the experiment plus something else. So I have to have, that's why I am looking at the diff in diff. The French economy in the mid-80s, many other things happened than just the liberalization. But so I'm doing the diff in diff. But of course, now let's imagine that in the fictitious world where only the experiment takes place, there's also going to be a common intercept. It's not going to come from the macro shocks that were hitting the economy, the French economy at the time. It's going to come from the fact that since I'm imposing the experiment on half of the firm, then all the firms are going to be, moving. Okay, and so that's the first term here. Is the effect on the control group? It's not multiplied by 1/2 because it affects all the firms. Okay. Okay, so that's the formula that you would want to apply if you wanted if you wanted to compute the pure effect of the experiment. So here is the problem now. Okay, so I know this formula. Okay, okay. So the problem is that in the data there are various problems. The first problem is that the effect on the control group, assuming there are no coincidental shocks to the economy. So it's not like the French economy is immersed in a global world where, I don't know, there is globalization and, you know, European integration and various things like this. No, that's not happening. I want to know the pure effect of the banking deregulation, okay? So that thing here, I don't know what it is. I have no clue. Okay, so I have no clue, and I don't know, because, you know, in a sense, if only the experiment happens, then it moves all the firm the same way, simply because the experiment feeds back into all the firms. But I don't know by how much, because I cannot measure this. I don't have this intercept. I cannot trust it because it is plagued by it is polluted by other shocks. So this, I don't know what it is. And also it turns out actually that thing, I don't know what it is either. Because that thing is the diff in diff. The thing that I plug into that formula is the diff in diff in a world where there is no macro shock happening at the same time. So I have to make sure that the diff in diff is actually not going to be different in a world where only the experiment is taking place. Okay, let's imagine I want to know the pure again and the pure effect of the French banking deregulation on the French economy. I have the diff in diff, but it's the diff in diff of the 1980s, while the French economy was hit by a lot of other shocks, such as the counter oil shock, the oil shock of the early 80s, the counter oil shock of the mid 80s, European integration, you know, the various trade agreements, I don't know, various competition reforms, the socialist government in the early 80s, the right-wing government in the late 80s, etc., etc. So all these things were happening. And so I use the diff in diff, you know, but this diff in diff is measured in those situations. Okay. While what I would want to have is a diff in diff that applies only, I mean, I would want to have the diff in diff when those things don't happen. So that's the second problem. So I don't know the missing intercept, and I don't know the diff in diff, in fact. So what we show is that under assumptions that I'm going to describe in a second, this is 0, and this is exactly what you measure. Okay, so that's what we're showing. So we're showing the conditions under which this holds. Okay, so there are conditions, of course, but, you know, it turns out they're pretty loose. The key mechanism that we uncover here is, in fact, that the distribution of the sales to of the log sales to capital ratio is invariant to macro conditions. So whenever, imagine now that I'm deregulating part of the French economy, and that's affecting those firms. Those firms are deregulating, they're producing more. Because they're producing more, you know, the overall economy is better, it's better off, okay? That thing is gonna lift, you know, the aggregate output of the economy. It turns out, you know, whether that lifts it a lot or not much does not change the distribution of MRPKs. So, because this is what buys us, you know, all these results. Okay, so the beauty of the distribution of the log sales to capital ratios is that they're invariant to. It's a bit like in the mean field game literature, where people are saying, okay, there's a mean field that affects everybody, and it's a good approximation, you know, even though there are more complicated interaction. Here, in the world I'm considering, that's the only interaction goes through these macro interactions. Okay. And in fact, they leave the distribution of distortions invariant to macro conditions. So it doesn't mean that the financial deregulation will not affect distortions, it will. But once it has, whether we're looking at the French economy or boosted French economy on steroid, this distribution is going to be the same. So we can isolate, in a sense, the pure effect of a deregulation on distortions using the difference in difference approach. What are the assumptions that we need here? Because of course we do need assumptions. Firms are allowed to follow a very rich class of dynamic models, but we need these two things. First, we need the Cobb-Douglas production function. So that's critical, we need that. Okay, it turns out that 99% of macro finance model have this assumption. So we are comfortable, even though, you know, it's interesting to explore. Again, that's, you know, that's part of what is not very much explored and quite interesting in this literature is that we know that production function is not Cobb-Douglas. It's some kind of, you know, first order approximation of how firms produce, but it's not the right one. And that has probably a lot of impact on macro finance research. But you know, that's something that that we assume because everybody else does, and that's already a start. And the second assumption here is that frictions are homogeneous. What does it mean? So that one is more innocuous. It's quite innocent, that assumption. What it assumes is that whether the French economy, you know, is as it is or is twice as big in terms of, you know, output, the fraction of firms that are going to be constrained is going to be the same. That the amount of money that is spent in adjustment cost is going to be the same. The idea is that those things here, the frictions, are not going to disappear with the growth of the economy. Okay, so it's some kind of a balanced growth path assumption in a sense. It's the idea that, you know, if I'm operating with an economy that is twice as big, there's going to be the same fraction of firms that are constrained, the same amount that is spent in various, you know, I don't know, equity issuances, in taxes, etc., etc. So all the frictions that I'm considering, which are like fairly wide ranging, you have taxes, you can have adjustment costs of various sorts. You can have financing constraints of various sorts. It can be, you know, cash flows. It can be lots of things, collateral constraints, etc. What they have to be is homogeneous. They don't disappear when the economy grows. If you make those assumptions, then you have this result. And then you can use the simple formula. So the bottom line is that if we want to estimate the pure effect of a reform, that's equivalent. Okay, so first, it's equivalent to estimate one of these complicated models here, the ones that I described here. It's equivalent to estimating one of these complicated models, okay? And just, you know, doing the stuff that we did in the previous paper. Okay, so sort of estimating, you know, take one of these models, the firm dynamics model, estimate the parameters, and then let's say, okay, we change the parameters in a way that is consistent with the reform, and then we estimate TFP before the reform, after the reform, and compare the two TFPs. We can do it this way. But it's quite cumbersome, and then you need to write down the model and all, and the model might be wrong. What I'm telling you is that as long as this model is part of this very large class of models, you just need to do the simple diff in diff here. The simple two-step method. That's all you need to do. Okay. Okay. So I told you it's complicated, etc. It's simple, etc. So it accommodates heterogeneous sectors. It accommodates input-output networks. The formulas are slightly richer, but not much more. In fact, a bit more complicated. I'm going to show you one actually in a second. But you know, that's not. It's not complicated much more. Okay. So I mean, we can take a simple aggregation model or a more complicated one. It turns out actually, in many studies, you need the slightly more complicated one, as I'm going to show you in our application. Okay, so let's move on to the application now. Any questions on the generic thing, or it's late, huh? Okay, so let's see so I'm going to skip the proof, etc. And let me, you know. So again, like the previous paper, that paper is a bit of a psychoanalysis in the sense that the previous paper was, you know, taking a reduced form moment in a paper that we had published that was showing that firms were not financially constrained, but we were very unhappy with, you know, the lack of quantitative implication. So there was the reduce for moment, you regress investment on real estate value, you don't know what it means in terms of TFP loss. So you need to write down the model. Here it's a bit the same, but a bit in a more indirect way. So back in the late 2000s, Marianne Bertrand, Antoinette Shore, and I published that paper, which was on the French banking deregulation of the mid-1980s, which was essentially a deregulation that organized an increase in banking competition. Okay, so it was not only this act, but a series of reforms that took place in the mid-80s, between 84 and 85. What you have to think about is that it was the French economy, the banking sector was completely under the control of the Treasury. Whether you were talking about private or public bank, it made no difference. Everybody was going to the governor of the Bank of France's office every Sunday night. And the CEOs of all these very big banks, they would sit down in the same room as the governor of the Bank of France, and the governor of the Bank of France or the director of Treasury would tell them, okay, this week, I think something we think would be a good idea would be to encourage companies to modernize and therefore to buy new robots, because we lack robots in France. It's very important. And so you should offer subsidized loans to companies that invest in robots. Or this year, BNP Paribas lent, or last month, BNP Paribas lent too much money. It didn't exist this way. This big bank was lending has lent too much money, and so this month you cannot lend as much money as before. Okay, so you have got to lend less money. That's because since there was inflation at the same time as the government trying to push credit, they had to impose credit ceilings on banks essentially. So banks wanted to lend a lot because there were subsidized loans everywhere, and the interest rates were low. But of course, at the same time, there was inflation. So the government was pushing in the opposite direction by trying to prevent banks from lending too much. I mean, it was sort of a mess. There was like subsidies everywhere. And so they took care of this in the mid-80s. And so in this paper, we evaluate the reform. And what we find is that we find evidence in the direction of better allocation of factors. So it's in 2007, what we essentially show is that we compare industries by their level of bank dependence. So that's kind of our treatment control kind of approach. So some industries were using a lot of bank credit, others were using less. It's a bit of the Rajan-Zingales kind of instrument. It's not a great instrument, but that's the one we have. And then we were saying, okay, what's happening when we compare those highly bank-dependent industries to the non-bank dependent industries? And what we found was something that we're saying, okay, bank loans became more oriented towards more profitable firms. So firms with high profitability were receiving more money from banks. And bank-dependent sectors also started to experience more entry and exit. So there were more exit of firms, more entry of firms. Okay, and also when we weighed by employment, by capital stock, etc. So there's a sense in which allocation became better thanks to this reform. But how big a deal is it? That's again the question we did not answer at the time. The question we can answer now because we have the machine.
David, I think we have a question here. Shutal, do you want to ask your question?
Yeah, go ahead.
Yes, sir. Feel free not to answer this question. So you mentioned that one of your results produced on the aggregate TFP relies on the assumption Cobb-Douglas.
Yes.
And in many, not all of them, many heterogeneous firm models. I mean, we don't use Cobb-Douglas. It's like a decreasing return scale, same as the model you estimated earlier.
Mm-hmm.
How the question is, if we deviate from Cobb-Douglas, is your result totally turned over?
But I cannot show the same result. You cannot, so you can still use the same method, but it doesn't have the same grounding. We are fine with decreasing returns to scale. It can be something like k to the alpha, L to the 1 minus alpha, all to the power theta. So it's fine. It can be decreasing returns to scale. You cannot. Okay. the only thing you cannot have is k to the rho plus L to the rho to the power theta over rho. So sort of CES, that doesn't work.
Oh, gotcha. Thanks. Yeah.
The thing is, people believe that's closer to the truth. But you know, it hasn't really made its way into macrofinance research. It's not one I've been exposed to. Long-term macrofinance research, I haven't seen much. There's in the Madrigal Zoo paper, actually, look at a function at some point, but otherwise there isn't that much.
Thanks.
It's one of their extensions. Any other question? I really have 2 slides left, so I can, I have time.
Actually, I have a question. Can the method be used when treatment is not defined at the industry level? Because we like to compute variances within industries in the misallocation literature. So is it important?
So you have
Go ahead.
It doesn't need to be industry, actually. The only thing I need is to have groups of treated firms, like enough firms in a group to compute a variance.
Okay.
It can be regional, it can be, that's fine too, yes. Yeah. It can be firms, I don't know, small firms and big firms, eligible firms, not eligible firms. You need to have groups. It cannot be fully continuous, otherwise I would be in trouble to, I need groups of firms. And I think I need those firms to interact with one another in a sense. For instance, I don't need an aggregate labor market. It can be a local labor market. It doesn't change at all the algebra. It's exactly the same formulas apply when you have local labor markets. When the companies that are in a group of treated firms interact with one another through the labor markets or the product market, it's fine. Yes.
Okay, thank you.
A related question. So if you also, I think the homogeneous assumption is also true that when you are computing these variances, the result of the treatment needs to be homogeneous among the groups, right? Otherwise, you would have something else, right?
What do you mean by that? Sorry, can you explain a little bit?
So let's suppose that you have a different treatment effects for different groups inside the same group that you are comparing. So let's say you have small firms that were affected by the reform and small firms that were not, and then you have very different effects between like the control and the treatment groups for these different groups inside the groups. Right?
So then you need to aggregate. If you have heterogeneous treatment effect, that changes the formula a little bit. Yeah, we have formulas to that effect. Actually, it works. We have formulas, but you need. Okay, I see what you mean. But you're saying within that group where I have treatment and control, let's say a region or whatnot, I need the effect to be homogeneous. Yes, that's true. Yeah, absolutely. Yeah. That's not exactly our setting here, because the setting here is really like, if you're in bank dependent industry, everybody's going to be affected. If you're in a non-bank dependent industry, nobody's going to be affected, or people are going to be affected less. So in this particular application here, I don't have this, but it's true that, we could think of an application like this actually. If there were like a regional heterogeneity, that would be interesting. Yes. Yeah. But for sure, I need within a group to have the same, to have homogeneous effects. Yes. Okay, so implementing the methodology, now it's very simple. What do? We compute the variance of the sales to capital ratio here at the industry level, and then we regress this on a post dummy, which is equal to 1 after the reform and 0 before, a treatment dummy. So there are 4 dummies like this. In fact, there are like 4 treatments because we split industries into 4 groups, very untreated, moderately untreated, very quite treated, and very treated. And we have a industry specific trend, as we did in the paper, and all the sorts of classical fixed effects there. so that's so the treatment here is really the pre-reform leverage quartile. Okay, so you can be in the bottom quartile of pre-reform industry leverage, which means that you're not really very much exposed to a banking deregulation. You don't need that much debt, or et cetera, from Q1 to Q4. And then the step 2 is simple, as I advertised, not quite as I advertised because I need to make a few precisions, but essentially as I advertised, you plug the resulting effect B hat M, which is this B hat here from the variance, multiplied by the treatment. So you have like 4 coefficients, so you get 4 coefficients, and you plug it into the aggregation formula. So I give it away. You don't have one treatment and one control. Now you have 4 treatments. Very treated, moderately treated, not very treated, and not treated at all. So you've got these 4 treatments. So since we have 4 treatments, it's a bit more complicated, the formula, because you've got like you've got 4 groups and not 2. And as a result, now you need to you have a slightly richer formula. This slightly richer formula also takes into account the fact, when I gave you the example, there was 1/2, and this 1/2 kind of got rid of complications that come from the reallocation of output across industries. So basically, when you're gonna think about those 4 industry groups, what's gonna happen in general is that if there is a bigger effect, let's say, on very treated firms or very treated sectors compared to non-treated sectors, when you have a very big effect on those sectors, then those sectors are gonna grow more. And because they're gonna grow more, they're gonna attract more capital to them, and that's gonna create a misallocation. Okay, so there's gonna be other effect, the reallocation of capital across treated and control, and so you have additional effect. And so essentially you need to run 2 additional regressions. So not just this one, which is variance regress something. So you need to run 2 additional regressions. One where you compute the mean of the variance of the sales to capital ratio in the industry, and the other one where you look at the covariance between log sales to capital and log sales. I can go into details, maybe I will have time, I don't think so. But essentially, this is 2 additional moments, and you have to plug these things. So you have to do a little bit more work. But it's really just 2 more regressions. And a slightly more complicated formula that I'm going to show you. But before I do this, let me just show you the result of this regression here graphically, just to convince you that it's there already. So that thing is the difference between Q4 and Q1, of the variance of log MRPK in the most exposed industry and the least exposed industry. Okay, and this is when the reform takes place. Okay, so when the reform takes place, essentially very simple. We've got the definitive Chianchino, very simple. The variance of log MRPK shrinks. That's what it did to the French economy. It aligned the marginal productivity of capital a bit more. Okay, so that's good, but it doesn't tell us, how much TFP we gained. And that's what we have here. Okay, so we've got 2 terms, the red term and the blue term. So let's focus on the red term here, because the red term is a very simple part. It's the one that you would want to compute, in fact. It's the one that is simple. What it does is that it takes the definitive of the variance, so it compares the variance in the treated versus non-treated sectors. Okay, so that's really the evolution of this. By the way, remember, since measurement error was an issue, measurement error kind of goes away when you take the definitive, okay? If you're hoping that measurement error is kind of stable. So here I'm taking within each industry, the forecasted, given my regression model, the forecasted change in variance. So it's gonna be, depending on whether you're an industry in quartile 1, quartile 2, 3, quartile 2. Okay, quartile 1 is the reference, so I have nothing. So that's the coefficient. You're putting the coefficient there. How much does it make the variance vary, okay, compared to the other sector. So it's really just the definitive. I don't have the level, remember, that's kind of my result. Very happy with that. Multiplied by the weight of industry S in total capital stock. So I take the capital stock of industry S, take the total capital stock of all the industries, and I weight, of course, it's the average weighted variance, you know, of all the, remember before what we had, it was just 1/2 times this difference in difference, okay? It's not 1/2 because, you know, the treatment is not 1/2 the treatment, 1/2 the control. Here it's each industry has its own weight, which doesn't have to be 1/2, you know, but it's essentially the same thing here multiplied by this, by the aggregation model. However, here, I have a second model. Okay, and what is this second model doing to me? This second effect, sorry, doing to me. The second effect tells me whether, hear me out for a second, the reform reallocates capital across sectors towards the industry that are the most distorted. So maybe, you know, some industries were more distorted than others. This is what this measures. Okay, so it's the discrepancy between the share in sales and the shares in capital of its industry. That's easy to compute. Okay, and what you have here is, okay, so it tells you, okay, is it the case that, and that thing here is the increase in output that we predict at the industry level. So is it the case that you expand more industries that are more distorted? If that's the case, you're gonna increase the amount of distortion, hence the negative effect here. Okay, so we don't know what this effect is in general. You know, it can be big, it can be small. I don't quite know, to be honest. In particular, but here it's very small, so you can just instantaneously forget about it. And then what we have is really the within industry shock. Okay, so overall, how much did we gain? 3% of total factor productivity. It's actually quite big. It's a big number. Okay, you just reform the bank. It's a big, you know, upheaval for the banks. It's really a big bank, but you know, you gain 3% of TFP. It's hard to get. You know, at the time, the French economy, it took 3 years to get this. Now it takes an infinite number of years because it hasn't grown for a long time, TFP here. But at the time, it would take 3 years of growth, yes, or even more actually. So you gain, you know, 3 years of growth just by having this reform. It's a big deal, really. Okay. In the paper, we also estimate the effect on output, and there, if you, I mean, we have formulas for output, and the beauty of the output thing is that we can compare to a naive estimation where we compute, you know, aggregate output naively. It doesn't take into account all the effects that we're talking about, and it turns out it gives a very big difference. It leads to a big difference. Anyway, so we find 5% of output, so that's a big deal, and 2.7% of TFP. So it's a big deal. Okay, so that's easy to apply to a lot of contexts. I know of someone who's doing it for subsidized lending, for instance, in Portugal these days. We'll see how much she's getting, etc., etc. But that's easy to apply. So that's it essentially. So let me just wrap up. If they have, can I ask a quick question? You have already. Let me just just skip this and then go to the conclusion. Do we have another application that I don't have to? Okay. Just since you know it's a summer school, you know, there are additional questions we've been thinking about, but you know, since we've been thinking about them, many other people can think about them. It's actually interesting questions. There's all the questions about the tax literature, where essentially here there's a lack of there needs to be a bridge with the structural, between the structural and the reduced form literature and the tax literature. So the reduced form literature has been very good at finding shocks to taxes, say corporate taxes, dividend taxes, etc., and see how firms react to that. Okay, so we have seen a lot of this. The thing is, that's not the way a policymaker would ask herself the question. What she would ask is, okay, now I can reduce taxes, but which one do I reduce? I cannot reduce everything, okay? And what is best, okay? And there, you need an integrated framework to have both levers and see, which one works best. So that's one space in which you would want to connect, what reduced form people have found with what structural people can do. Another thing that we're working on these days, and so we're going to have a paper soon, is on the labor share. So imagine you have a mandatory profit sharing program that affects a few firms, okay? And we're seeing that those firms actually, pay their workers better because they're sharing their profits with their workers. We can show this. We can show that it happens, okay? But it's hard to tell, just by looking at the descriptive, at the difference in difference estimators. It's hard to tell how much a mandatory profit sharing that would be expanded to the entire economy would affect the labor share at the level of the economy. So, what would be the macro effect of this? So again, some kind of scaling up. There are formulas that you can derive coming from difference in difference or bunching. There's actually an aggregation, and then we have done nothing, even though we feel it's important. There are two things. So first, try to connect more with the the more dynamic macrofinance literature. So our model is a model in steady state. So it's very similar to the first model I described. So here, how can we accommodate business cycle fluctuations? It's not easy because we've got heterogeneous firms, but that's something that we should think about. What kind of sufficient statistics we can find there. It's difficult, but it's, I think, interesting. And the other part is really stop focusing like Xi and Kino on capital K and start thinking a little bit more about innovation and growth. Since this is, also a big deal, and this is where we have enough data and evidence that we can probably find useful sufficient statistics there. That's it, really. I'm happy to stay on for a few more minutes if some of you have questions, unless Alexi shuts us off. Thank you very much for your attention, everybody. You've been very patient.
Thank you.
Thank you, David. Please, everyone, welcome. Join me in thanking David for a great talk on this really important topic. If you do have any questions, we can do a minute or two. Otherwise, thanks again. Tomorrow we have another of David's colleagues from MIT, Antoinette Chouard, is going to talk about payment systems and cryptocurrency markets. So please come back for that. But in the meantime, again, thanks a lot, David. We really appreciate it, and we look forward to seeing where this agenda goes next.
Thank you very much, Alexi, and everybody for the invitation and everybody for their attention. Thank you very much. Bye-bye.
Bye.